Good morning, everyone. And I'm going to do a sound check with the folks on Zoom because we have over 240 people that registered to join us virtually, in addition to everybody in here. So this is a fantastic crowd. For those who are joining us virtually, can you just give a thumbs up in the chat if folks, okay, we already have it. Thank you very much. Okay, it's 9 o'clock sharp. It's a couple minutes after. So we're going to get started. My name is Claudia Bridges. I am the former territory manager for the Columbia Territory Spec. I retired last year, and I am fortunate enough to be working with Kara and Catherine and her team to roll out Vita across the state. And so I'm excited to be able to keep participating in this, and I'm excited for all of you guys to be here and join this training. One thing I wanted to mention is that you guys need to know that this training is not what every state or every territory does. We really work hard to put this together for you all. And so we're very proud of the fact that even despite no funding at this point, we're able to put this together. And so for those in Zoom too, I wanted you guys to know we got over 100 people in this room, plus everyone that you've got that have joined us virtually. So I want to give a little bit of housekeeping before we get started and basic information. Restrooms, we have 3 different areas on the top floor. You can go out down the sign that says dental clinic. Right behind the front desk, there is a blue door, and on either side of that door are restrooms. And you can go all the way down to the right, and there are restrooms there. So we have plenty of restrooms. Don't feel like you need to wait in a line at the closest location. Downstairs, we will also have restrooms, and that's where lunch is going to be. So the blue door that I just mentioned, for those that don't want to walk down the stairs, the blue door is the elevator to bring you downstairs. Okay, so that should cover that aspect of getting started. I do want to mention, please, cell phones off. Okay, we've put a lot of work together to put this on, and we don't need folks sitting tangling on their cell phones. I will say the same about laptops too. If you've brought a laptop, please keep in mind that you're keying and clicking, everybody hears, even if you think you're quiet. And I will also tell you the people in the row behind you are reading all your emails, they're reading Yahoo, they're reading everything else. So my point is, unless that laptop is critical, shut the lid, okay? Out of respect for the people sitting next to you, behind you, in front of you, and the instructor, okay? Let me think what else. I'm going to call Jason Hutto up. So if Jason can come up, Jason is the IRS spec relationship manager manages a good number of the partners here, but manages Kara, who oversees everything with Reinvestment Partners. I'm going to give you just a minute to say hello. Okay.
Hey, good morning, everybody. It's a pleasure to be here. Just want to thank you all for your continued support of this program. You know, you guys are the lifeblood behind this. I wouldn't be here if you weren't here, and I know all the thousands of taxpayers that you serve are very thankful for your services. So I brought my equipment here. If anybody needs some assistance during lunch or something, I'll be here all day. Please let me know. But just know it's individuals in my position, it's our job to take care of you. So whatever we can do to help and support you have a successful filing season, please reach out to your relationship manager, our territory manager, as well as Grace Torres. Since last season, we've combined 4 territories into one. So we've expanded significantly, but we've also had a 25 reduction in workforce. So a lot more work, but you know, the job isn't done. So it's a pleasure to be here, and I hope you'll have a wonderful day.
Thanks, Jason. Thanks for supporting everybody here. So a couple of other things. I want to talk about the chat. That's for those folks who are joining virtually. The only thing that should be going in the chat is a question. No comments, no responding to somebody else's question. Please let that be handled on our end. Kara is monitoring the chat for questions. We're going to say them so that Bill can respond to them if Kara doesn't answer it immediately. But it's really hard for us to monitor the chat when it turns into just a conversation of people adding in, adding comments. We're scrolling wildly to see where are the questions that need to be there. And we also don't want anyone else answering those questions other than Bill or Kara, because that's why we've put this whole thing together. I want to give a big, big thank you to Alamance Community College for sponsoring us. And I want everybody to keep that in mind because they really worked with us to say, sure, you guys do amazing work across the state, and we're going to help you out with everything. And they have bent over backwards for us. I believe the accounting professor from Alamance is here. I'm going to call her out. Okay, thank you for joining us. I will say, if there's any students of yours that came, we don't have enough packets. Okay, we only printed enough packets for our volunteers who are here. You will be emailed, everybody in this room, you will be emailed the information after this event. And I'm your point of contact on that, so it'll be coming from me. Everyone virtually already received the PowerPoint that Bill's about to go over with the attachments. So if you didn't get a packet today or you feel like something's missing, no worries, you're getting everything right behind me. Can you think of anything else? You guys okay with that? Okay, then I am going to turn it over to Bill Hawkins. Thank you again for creating this training, putting it together, and I hope you guys realize how many hours he puts in to create this for you all. So thank you for thanking him.
Okay, well, this has been an adventure this year putting this together. The one big beautiful bill is challenging enough without getting much guidance on it. So we're going to talk about a lot of things today. I'm going to take you down some rabbit holes that you may not want to go down, but I'm going to bring you back out of them. So I promise you, sometimes it'll get complex, but I try to simplify it at the end. I know the level of training I do is more intense than some people like and less intense than others like, but hopefully it's a happy medium. By the way, who don't know me, I'm a retired tax attorney. I worked in law firms and the corporate world before retiring, moved to Wilmington, North Carolina. I'm one of the site coordinators at the New Hanover County Senior Center Vita site there. We did about 2,500 returns last year, so we're a big site, lots of folks. We do an appointment system for our drop-off, and we fill it up the first week of March. So we could use 3 times the number of people we got, and we'd still have plenty of work to do. This today, we're going to talk a lot about the One Big Beautiful Bill, obviously. The handout that you have is basically the text of these slides. There'll be some things that'll be on the screen that you won't see on yours, but they're things like pictures of forms and stuff. But otherwise, the text that's up here is in your handout. So don't feel like you've got to write down a whole bunch of notes because it's already there. I know the way I do PowerPoints is probably not the right way because they tend to be very wordy. But the whole idea is that you're not going to remember. You may have seen there are 234 slides today. You're not going to remember all this stuff. It's the handout that's really the most important part of this, to walk away with that handout, because it should be a resource for you throughout the tax season. I think there's a pretty good chance we're going to get additional guidance. I'm hoping we're going to get additional guidance from the IRS. So you may get some updates from me, emails through Reinvestment Partners, through Claudia probably, if we find out more things than what we know now. So I'll try to point out, you'll see in the slides, there's some things where I kind of say, don't know the answer to this one. And we can have a conversation if anybody else thinks they know the answer to it. But so again, I expect that we'll probably get some updates after this is over. Okay, so what are we talking about today? Obviously, the bulk of this is what's new for 2025. The One Big Beautiful Bill, I put beautiful in quotes because beauty is in the eyes of the beholder. And some people, including myself, after spending the last 5 months working on this, would probably use a different adjective for this. ACA changes, they're pretty amazingly extensive changes to ACA. I'm going to focus on the tax, but I'm going to talk briefly about other ACA changes. Not that I'm an expert in it, but I just think it's important that you hear. There are some people in this room, like Mike McDonald, who are experts in ACA. I'm sure some of the others of you are involved in this as well, but I want to kind of give you an overview so you see the breadth of what's going on with ACA to understand that it's going to probably have a pretty dramatic impact on a lot of our clients. Whoops. Then we'll talk about some other 2025 changes. There are a few other things other than the one big, beautiful bill to talk about. And this is kind of similar. Those of you who have borne through this with me before, I kind of use a similar pattern every year in these. So we'll talk about inflation adjustments, form changes, tax layer changes, North Carolina changes, which is going to be a very short discussion, and scope changes. And finally, the AOC workbook. If I still have the energy and we have the time, we'll talk about that a little bit at the end. As for breaks today, I'm going to try to do them at certain points in the presentation. So hang with me. I'm trying to do about a fourth of it before our first break, a fourth at lunch, and then same thing in the afternoon. So bear with me. Hopefully those will work out well for everybody. Okay, so July 4th, the president signed the One Big Beautiful Bill. I'm going to refer to it as OBBB or OB3, whichever one I happen to say, which will dramatically impact our clients. There are more than 30 tax provisions in OBBB that impact our clients, with about a third of those happening in 2025. So one of the handouts that you may have gotten, or you will get if you didn't, is just a one-page summary I put together, and we're going to see this later on, to show you effective dates of the key OBBB provisions, because they're all, there's some are in 25, a bunch are in 26, some are in 27, some are in 28. So it's important that you kind of keep a track of that, because you're going to have clients coming in this year like saying, well, I thought I got to deduct my charitable contributions again. Sorry, that's next year. That's not this year. So we'll talk about timing on all these things. So there are significant changes to the Affordable Care Act. Most of them have nothing to do with tax. We're going to look quickly at the overall changes, but talk a little bit more about the tax aspects. You're going to hear me say this a couple of times. If you've never looked at, if you care about ACA, this Beyond the Basics website is fabulous. It has an incredible wealth of knowledge about the Affordable Care Act. You can sign up for email reminders from them and stuff. That this is the place to go if you have questions about the Affordable Care Act. You're going to see I borrowed generously from some of their stuff, because I'm not an expert in this. They do a great job of summarizing, so I'm going to borrow some of their stuff. Okay, first stop is the big warning. Watch out for the 4012 and the 4491. It has not been updated for OBBB. The 4491 has a little short summary at the very beginning on what's new for 2025. That is correct. That's the OBB thing. 4491 does not reflect the OBBB at all. That led to problems with the test that someday we'll all get to take, but we're not sure when. But the standard deduction thing, the test is correct, 4012 is wrong. The IRS told us we should do what the 4012 says, even though it's the wrong answer, all that kind of stuff. I won't go any farther with that one, but just know, be careful if you're using the 4491, because it doesn't show you, or the 4012, because it's not showing you what's new with respect to the OBBB. Primary tax provisions of this bill. So the OBB has a number of things in it. The biggest thing is it permanently extended most of the stuff that happened in 2017. Yes? Okay, sorry. So mostly what it's doing is it's extending what was done in 2017. So we had the Tax Reform Act in 2017 that added a bunch of big changes to the bill, and that's primarily what this was focused on. But it also adds some temporary tax breaks that we're going to spend a lot of time on today, as well as some not so nice changes that will impact many of our clients. and the bill, to no one's surprise, kills direct file. So I predicted, you may remember from last year, that was coming, and it did. Permanent changes that were made. So the difference between permanent and temporary obviously is exactly that. Permanent means these are now in the law forever. So when the 2017 Act was done, all these changes were temporary changes that all expired at the end of 2025. And that's because of the budget reconciliation process that Congress went through to pass it. This time, they were able to make them permanent. We'll talk about that in a minute, but had we reverted back to 2017, which that was the big fear, that we were going to revert back to pre-2017 law, we would have had higher tax rates, lower standard deductions. We would have gone back to having personal exemptions. We would have had a $1,000 child tax credit and no other dependent credit, among a bunch of other things that happened. Congress chose to extend all of these changes on a permanent basis through what I call some creative accounting. Normally in the budget reconciliation process, you wouldn't have been able to do that, but they made up some things to convince themselves it was okay to extend it on a permanent basis. So these are all now permanently in the law. There's no more expiration of these basic things. And we're going to talk about other things that are temporary, but these are all permanent changes. And some of these that got extended permanently, they also changed them in the process, and we'll talk about those changes later. So the big things that became permanent are the 2017 tax reform had reduced tax rates significantly. Those are now permanently locked into the law. The standard deduction had increased the 2017 tax reform had increased standard deduction dramatically. That's now permanently in the law. The personal exemption was eliminated. That's gone for good. Child tax credit doubled in the 2017 tax reform, and they increased the refundable portion. All that stuff is now permanent. It went from 1,000 to 1,400, but the 1,400 is inflation adjusted, so it's up to 1,700 now. It introduced the other dependent credit for $500, so that's now permanent. It created the 7.5% floor on itemized deductions for medical expenses. It put in the $10,000 cap on the deduction for state and local taxes that we're going to talk about later because they changed that pretty dramatically. And it imposed the $750,000 cap on mortgage debt. It also got rid of most miscellaneous itemized deductions like employee expense deductions. These aren't really going to impact our client the way they think about it because it's not going to change kind of the way it's been the last few years. So while these are dramatic changes, it just kind of looks the way that it's looked since 2018. So these won't stand out to our clients. However, it makes a lot of other changes that are significant. So now we're going to focus on what OBBB does that changes 2025. So we're going to talk a lot about the 2025 changes in OBBB. Then I'm going to talk about and give you a summary of what's to come with OBBB, just so you're familiar with it. Partially because, again, I think some clients are going to expect things to happen this year that aren't this year. So again, some are 2025, some are later years. Now we're going to focus on the 2025. So the first thing was standard deduction. So as we already said, the 2017 law doubled the standard deduction approximately, and then we've been inflation adjusting it since then. Congress, as part of the One Big Beautiful Bill, bumped it even further. So for example, and this was the issue with the test question, was MFJ in our normal inflation adjusted from last year would have been 30,000. They bumped it up to 31.5. So we got a over $2,000 increase in the standard deduction for 2025. So you'll see that middle column shows you what the standard deduction now is after One Big Beautiful Bill. I gave you the 24. I also gave you the North Carolina because we're going to talk about this later when we talk about itemized deductions. You got to always keep the North Carolina numbers in mind. You remember a few years ago, North Carolina finally caught up to the federal. Well, that didn't last long. So the federal is now quickly eclipsing North Carolina again, which then creates a challenge for all of us with itemized deductions because you got to remember You might not be able to itemize for federal, but you still could for North Carolina. The bill permanently increased the child tax credit from $2,000 to $2,200, and again has an inflation adjustment for that in the future. So this year it'll be $2,200. Inflation adjustments will occur in later years to that number. The refundable portion of the credit was not changed, so that they left that the same. So even though the total credit went up, the refundable piece remained the same. So this year it's still at $1,700. That's the same as it was last year. There was no inflation adjustment for this year, but we'll see what the future holds. If you've ever looked at the way the child tax credit actually works, you have to have at least $2,500 of earned income to be able to get the refundable portion of the credit. That's now been made permanent, as well as the income phase out. So as your income gets too high, you phase out of child tax credit. That is now a permanent feature of the law. Okay, child tax credit. So one of the significant changes for 2025 is that it adds this concept of a valid SSN. We've seen this before with the earned income credit. We've seen it partially with child tax credit before, but we're going to see how it gets expanded this year, and we're going to see this a lot. So I've highlighted the valid SSN throughout this because we're going to come back later at the end and go back and see what does it take to be a valid SSN. So as we go through it, I'm just going to tell you, yeah, they added the valid SSN. Later on, we'll see what that actually means. Under prior law, the child tax credit could be claimed with respect to a child only if the child had a valid SSN, which allows the child to work. So a valid SSN is basically one that allows you to work in the United States. The taxpayer was only required to have a taxpayer identification number, which is any SSN or ITIN. So it looked exclusively at the child for purposes of qualification for child tax credit. What OBBB does is it now adds that to the taxpayer. So it requires both the child and the taxpayer to now have a valid SSN to be able to claim the child tax credit. One nice thing the Senate did, which the House had done the opposite, but in the Senate it said in the case of a joint return, only one of the spouses has to have a valid SSN. The House would have required both to have a valid SSN. The new valid SSN requirements apply to 2025 returns. So we got to look for this year, and you're going to see the 1040's got some changes, and TaxSlayer has some changes to make sure we're capturing all this valid SSN stuff. Next is the senior tax deduction. So everybody's heard a lot about this. One of President Trump's campaign promises was to exempt Social Security benefits from tax. So a lot of people still have that in their head, that they're not going to pay taxes on Social Security. But unfortunately, that didn't work out because, again, I mentioned this already, they passed the bill through what's called budget reconciliation. That has all kinds of rules. What it allows the Senate to do is pass it by majority vote instead of the normal 60 vote requirement in the Senate. But under budget reconciliation, there are lots of restrictions on what they can do. One of those is that it can't impact Social Security. And the problem is, one of the problems is that the taxes that are imposed on Social Security actually go to the Social Security Trust Fund. So if you took all those taxes away, you would have hurt the Social Security Trust Fund, which would have caused it to go under even faster. As a substitute, Congress decided to enact this senior tax deduction that applies to virtually all seniors below certain income levels. So for seniors who still have a portion of their Social Security tax, you need to be prepared to talk to them about this, because we've already had people at our site who've called in or just commenting in a casual conversation with some of our preparers that they've run into at the senior center, something about, oh, I understand I don't have to pay tax on Social Security anymore. So a lot of people are going to be coming in with that mindset, and when they see you start explaining their tax return to them and tell them they've got tax on Social Security, they're going to go, well, wait, that's not the deal. President Trump said I wasn't going to have to pay tax on Social Security. Well, that's not the way it worked out. So there are going to be people who are going to still be taxed on their Social Security, but because this is a $6,000 pretty much across the board, a lot of people are going to win, even though it didn't really impact their Social Security taxation. As with all deductions, there will be winners and losers, and the losers won't be happy. OBBB adds a new deduction for seniors that operates like a personal exemption. So one of the confusions is this is not part of the standard deduction. It's not an increased standard deduction. This is a personal exemption. The reason that's significant is because if you itemize, you still get this senior tax deduction. So this is an additional deduction. I'm going to get technical on you, but if you look at the tax return, we start with total income, then we talk about adjustments to income to get what's the term adjusted gross income. Then we take deductions to get down to what's called taxable income. The deductions include the standard deduction, but we're now going to see it's also going to include the senior tax deduction, the tips deduction, the overtime deduction, the car don't, all that's going to be in between AGI and taxable income now, which means for all these, itemizing has nothing to do with your ability to take these deductions. So the amount is $6,000 for each taxpayer who reached age 65 by the end of the tax year. In the case of the 25 tax year, that means you were born before January 2nd, 1961. There's a funny rule in the tax about sometimes if your birth date's January 1, sometimes you're one age and sometimes you're another age. For this purpose, if you were born on January 1, 1961, you're treated as 65, even though you weren't 65 at the end of the year. Again, taxpayer has to have a valid SSN like child tax credit. So if you're claiming the $6,000, you got to have a valid SSN. So if only one spouse has a valid SSN, only one of them is going to get the senior tax deduction. Again, this is not an itemized deduction, but instead is the deduction computing taxable income like the standard deduction, and thus it applies to any qualifying taxpayer, whether or not they itemize. But as we're going to talk about, there are income phase outs. So higher income people are going to lose the senior tax deduction. The deduction begins phasing out at modified AGI above 75,000, 150,000 on an MFJ return. And the way the phase out works, basically it's totally eliminated at modified AGI over 175 and 250,000 for a married filing joint return. Modified AGI, we're going to actually see what the form, how the form calculates this later, but it's basically AGI less some excluded foreign income stuff, so not something that's usually applicable to our client base. The deduction is not available to married taxpayers unless they file a joint tax return. You're going to see people use that terminology a lot. Be careful, because the same exception that applies for a married taxpayer to file head of household applies here, because for tax purposes, if you qualify for the exception to head of household, you're treated as not married for tax purposes. So it's a bit of a misnomer, and the IRS actually repeats this in the new instructions that just came out this week, the draft for Schedule 1A that we're going to see has all these deductions in it. It uses that terminology that you have to file a joint return. That's a little bit misleading. Basically, as we're going to see, you can't file an MFS return. So the head of household exception, which I'm sure you all remember, is the taxpayer has to maintain a home, which constitutes for more than half the year the principal place of abode of a qualified child. Taxpayer has to pay more than half the cost of maintaining the home, and the taxpayer didn't live with a spouse during the last 6 months of the year. So if you're married and qualify for that exception, for this purpose, you're not treated as married, so you can claim this by filing as head of household. Again, I just said, including the IRS instructions, talk about you have to file a joint return. That's not correct. Fortunately, TaxSlayer does it properly. If you do a return with a married person filing head of household, TaxSlayer will give them the senior tax deduction. Now, this is the beginning of our temporary cuts. So this is only for the tax years 2025 to 2028. Can anybody figure out why they picked those 4 years? Good job. So this is going to be a temporary provision. We'll see whether or not it gets extended, but it's for the next 4 tax years. So this is the new Schedule 1A. Some of you may have already seen this. This will be another schedule in the return that we'll be adding. So the first thing it does in Schedule 1A Part 1 is to compute that modified adjusted gross income. So it starts with basically adjusted gross income, and then it makes the following adjustments. This one's for excluding Puerto Rican income. These two are related to foreign earned income, and the last is for American Samoa. My bet is you'd have few, if any, taxpayers who are going to be impacted by that. So again, it's basically AGI for us. And we're going to see that this applies to all of these new deductions that we're going to talk about. So this is the section, Part 5 is the computation on the tax return for the senior tax deduction. So this first section up here, this is the income phase out where it's computing if your income's above 75 or 150, it does that phase out calculation for you to figure out how much of the 6,000, if any, that you get. And then the part that we care about is, so if you've got a valid SSN and you were born before January 2nd, 1961, enter the amount from line 30, which would have been the amount after the income phase out. And if you're married filing joint and your spouse has a valid SSN and was born before January 2nd, enter that amount. That's the computation. Nice thing is for us in TaxSlayer, you don't have to do anything. You just got to put in the right birth date for people, and then it will figure out whether or not the senior tax deduction applies, and it will automatically calculate it. So there are no additional entries that have to be made for the senior tax deduction. We're going to see this now come in on Form 1040. Right after qualified business income is another one of these deductions that are between AGI and taxable income. We're now going to see this new 13B, which are all these new temporary deductions we have are all going to come in on that one line. Okay, I'm going to take a stop before we go there. Any questions so far? Just give me a chance to get a sip here. Yes, ma'am. I'm sorry. I have to remember to do this because otherwise I get yelled at.
So you said on TaxSlayer software that the volunteers use that everything is already built in with the OB3.
TaxSlayer, my testing so far, we'll see if anybody says anything differently, is that TaxSlayer does have OBB in it. It does have tax. We're going to see it does the senior deduction. It's got tips, overtime, car loan, interest are all already in there. And the correct standard deduction and all that stuff.
So that means it also applies to the link that is connected with the File My Taxes for Free if they don't come to the Vita site.
I do not know the answer to that. All I know is TaxSlayer is correct. Anybody know an answer to that? Nope. No, can't answer that. All I'm going to tell you is what TaxSlayer does. Any other questions? Yes. Hold on. You can't. You got to talk with this because people on Zoom can't hear you otherwise.
Right, thank you. My question is mainly for Jason. When will the test answers match our publications? If we were to take the 6744 now and take the test, will it be correct on our answer sheet, but incorrect for the purpose of completing our tax returns? Or when will they meet?
I think he's avoiding that question.
It's not online yet, so until I get in there and delve in, I won't have an answer to that. It was online briefly last week, but it's offline right now. I'm sorry. It's supposed to be in the middle of this month, but yeah.
I can tell you that,
changes,
you know, there was one question, it's on the basic test about, that was a standard deduction question where the question on the test was, what was the standard deduction? It used the correct answer. It used the OBBB answer, and the 6744 used that answer. The IRS decided to send out a volunteer tax alert to basically change the answer to what the 4012 says, which is the incorrect answer, to change it to 30,000, because they knew that people would be using the 4012 as the resource and it hadn't been updated. And then they subsequently had to send out an email to explain that volunteer tax alert. So that's a bit of a mess. But first of all, for those of you who take the basic test, if they're playing around with the answer to a question, it's probably because that's the right answer to the question. I'll just say that. So were there other questions? No other questions? Okay. All right, tips. This is going to be fun. So you'll see I entitled this No Tax on Some Tips. This is going to be, we're going to see this pretty consistently through here. Taxpayers' perception of what the law is and what the reality is are going to be two different things. So the law adds a new temporary provision, again, for 2025 to 2028, that's available, again, without regard to whether you itemize. The statute provides the deductions provided for the quote unquote qualified tips. We're going to talk about what that means a lot, so we'll come back to that, but received during the year that are, and this is the key, that are reported on a form W-2, 1099 NEC, 1099 MISC, or a 1099K, or by the taxpayer on a form 4137. We're going to go back through this. You're going to hear this again, but that's really the key, is the statute requires that it be reported on one of these forms before you can deduct a qualified tip. To be qualified, it has to be reported on a form. We're going to talk a little bit more about the reporting requirements. Unfortunately, the IRS decided that for 2025, that it was going to waive the reporting requirement for 2025. The statute has very strict reporting requirements for payors of tip income. So for next year, we're going to get lots of great information, but this year is going to be a challenge. So the maximum amount of tip income that can be deducted on a return is limited to $25,000 regardless of filing status. So for example, I don't think I said this, but no, but on a joint return, one spouse can have $25,000 in tips deducted. It's not a per spouse rule or anything like that. It's a by return. So it's the same without regard to your filing status. It's $25,000 per return is the cap. The maximum deduction begins phasing out for incomes above $150,000, $300,000 for MFJ, so a pretty high income phase out level. Employers and payors of tips have substantial new reporting requirements that require separate accounting for tip income on forms W-2, 1099 NEC, MISC, and K. However, the IRS, again, has delayed those until 2026. So some of you may have already seen their drafts. I mean, they're actually real copies of these forms already available for 2026. So for example, in Form W-2, what we're going to see is box 14 is now going to require the employer to report what are the qualified tips. And it's also going to include the occupation code that we're going to talk about in a bit. So for 2026, 7 and 8, this is going to be easy. Unfortunately, you're all preparers this year, and so you've got to deal with the headache of this year. It has nothing to do with Social Security, Medicare taxes. So you're still going to get subject to employment taxes on your tip income. This is all just for income tax purposes. And for self-employed people, that means it's subject to the 15.3% self-employment tax. So as we're going to talk about later, I don't think we're going to have a lot of self-employed people volunteering cash tips to us because they still got to pay the self-employment tax on it, even if they don't pay the income tax. If you don't owe tax after the standard deduction, this deduction is not going to do you any good. I've seen estimates that various groups have made about who's actually going to be impacted by this. They think that about 40% of tip earning taxpayers don't have enough income to even pay tax after the standard deduction. So this deduction is going to do absolutely nothing for them. And as high as 60% of the workers who receive tips won't benefit because of all the various limitations that are contained in the provision. So again, I think the perception of what this is going to do in the reality are really two different things. So the IRS has issued 2 notices. I've given you the sites for the people who are really into this stuff. You can go read these long, boring notices that talk about the specifics of all of this. So the first one, 2025-62, was for employers and payors to tell them how do you have to report for 2025. The second one that just came out on November 21st, I think, is for taxpayers, telling taxpayers, here's how you have to report qualified tips for this year. We're obviously going to talk about those in detail because that's really the rules for this year. You can forget the statute and what it requires because these notices basically override the statute. Fortunately, I'm going to tell you about what all these notices are going to tell you. We'll be discussing the application of the tips for 2025 in light of these notices. We'll talk about all the other requirements next year. So next year, there will be some other things that will come back into play. We don't have to worry about them this year. So I'm just focusing on the 2025 rules for no tax on tips. So I'm going to first focus on the reporting rules because this is kind of telling us what are we likely to see from our clients. So what are they going to come in with to help us figuring out whether they've got qualified tips or lack thereof, which is probably the most likely situation. For future years, again, the various information reporting forms will lay all this out for us. So again, this is going to get easy for next year, but for this year, it's not going to be easy. So the notice to employers and payors provides penalty relief. So even though statute said they had to separately report, they said, well, no, for 2025, you're not going to be subject to a penalty for not doing that reporting, but there's several things the employer, there's one thing they have to do, and then some other things that they ask them to do. So to obtain this relief, the amounts reported as income on the information return have to include the amount of qualified tips in the income reported, which that should have been the case anyway. So that means on a W-2, it's going to be in box 1, because box 1 says wages, tips, and other compensation. So the tip amount has to be included in box 1. That's always been a requirement. So that's not any kind of change here. But for it to be a qualified tip, it's got to be reported as income. The W-2, the amount of tip income, again, going to show up in box 1, but the amount of tips doesn't have to be separately stated. So then, and I'm going to do some quotes here because I want you to see the language that the IRS used in these notices. The notice then states, quote, and the emphasis is mine, while not a requirement to receive the penalty relief provided in this notice, employers and payors are encouraged to provide employees and pays, particularly those in a tipped occupation, with the occupation codes and separate accounting of cash tips, such that the employer or pay has the information they need to be able to determine whether they can claim the deduction for qualified tips. Employers and payors can make such information available to their employees and pays through an online portal, additional written statements furnished to the employees or pays, or other secure methods. So the key to that was the word encouraged. So it's not a requirement. They're encouraged to provide this information, but not required to, which is really fascinating because when we get to the vehicle loan interest, you're going to see, even though they've say, hey, we're not going to make you file a new form, they're still mandated to provide that information for vehicle loan interest. But they chose not to do that for tips and overtime. Not sure why, but that's what they decided to do. So we may get lucky and have a taxpayer that shows up with information box 14 of the W-2 about tips, or they may get some kind of a statement or some other information from their employer that details the amount of qualified tip income, and they may even have a qualified occupation, the occupation code for 2025. We're going to talk about occupation code in a minute. But it's possible that we're going to have some people who will show up with that information. I personally will be a bit shocked to see that, but it's possible that you will do that. So one of the things I'll come back to that point. We'll have taxpayers show up with nothing, wanting to claim the tip deduction. We should ask if the employer payor provided any information about the tip income, but I say we probably, I think that's pretty certain, we'll be faced with situations where no information is provided. But again, you're going to want to push to see Did they get anything from the employer? Did they get any kind of statement? Is there some online portal they can go to that has additional information? But ultimately, we're going to get confronted with nothing. So the second notice was the taxpayer notice. This was sent out it was released on November 21st, and it provides the detailed rules for taxpayers who want to claim the tip or overtime deduction for 2025. So we're going to talk about the tip deduction as modified by this notice. So this is kind of a summary of the tip deduction rules for 2025. So I've broken it down to 3 different groups of requirements. So the first one I'm calling, these are my own way of kind of summarizing it. So I think there are 2 what I call taxpayer requirements. First is you have to have a valid SSN. This is going to become a repeating theme in this presentation. So you've got to have a valid SSN. On a joint return, the taxpayer claiming the tip deduction has to have a valid SSN. Second is you can't file MFS. So again, we're going to see pretty consistently, but not completely consistently, that you can't claim these new deductions if you file MFS. But you can if you file any of the other filing statuses. So next is there are certain requirements that the tip has to qualify to meet. So for the tip to be a qualified tip, it has to have the following characteristics. Tip has to be reported as income. We've already mentioned that. So it'll show up as income on one of these forms. We're going to talk about the implications of that later on. But it's got to be reported on one of these forms. The tips must have been received in a business. This is the language from the statute, that customarily and regularly receive tips on or before December 31, 2024. So we're going to talk about what that means later on. Tips received in any illegal activity, prostitution, or pornography are not deductible. The tip must have been a cash tip, included by check, credit card, debit card, gift card, tangible or intangible tokens, whatever those are, or casino chips. It doesn't include basically gifts in kind, so event tickets, meals, services, or any other assets, including digital assets. So if you get paid in crypto, that's not a cash tip for this purpose. Tip has to have been voluntarily paid. Automatic service charges or non-negotiable tips do not qualify. So there's a lot behind this one. I kind of just summarized it, but it has to be voluntarily paid by the customer. So we all know the example of you go to a restaurant and it says parties of 6 or more, we're going to impose an 18% service charge. That is not a cash tip for this purpose. It's not a qualified tip. It has to be something where the taxpayer has the right to say, no, I don't want to give you anything. So if it says 18%, we suggest 18%, that's fine. If the customer can say, no, I'm not going to give a tip, that's fine. But if it is a mandatory, they usually call it a service charge, that is not a cash tip qualified tip for purposes of this deduction. We'll come back to what that means for us in a bit. Designate that information. So starting in 2026, the employer is going to have to make that distinction. So when the employer reports, the question was, is the employer have to tell us this about whether it was voluntarily paid? And the point is for 2026, yes, the employer will have to make that distinction when it figures out the tips that have been reported, how much of those were because of a mandatory service charge versus how much of those were voluntarily paid. I'm telling you the rule. I'm not telling you what's really going to happen, which who knows. But that's what the mandate is going to be to employers, is they have to tell you how much you got in qualified tips. So they are going to have to go through all these rules next year to figure out what's qualified tip. For 2025, there's no such requirement. The tips can't have been paid by an employee or an owner of the payor. So for example, if you're my employee and I pay you $10,000 a year to do something for me, and then I decide, hey, you know what, for this year, I'm gonna make it $9,000 and you got $1,000 tip, so you don't have to pay tax on it. That doesn't work. That would not be a qualified cash tip. Okay, so those are kind of the tip requirements, and we're gonna come back to some of those when we look at some real world examples in a minute. But there are also then calculation requirements, and this is gonna be our real challenge. As if the other stuff isn't gonna be challenging enough. So again, has to be reported as income for employees, and it's actually gonna end up not being bad for employees. We're gonna see it's a lot worse for self-employed people. For employees, the tips either should be shown in box 7 of the W-2, reported tips, or on a form 4137. I'm gonna walk you through how tips, a primer on tips in a little bit, so you'll understand all that terminology if you're not familiar with what are reported tips, what are unreported tips, what are allocated tips. I personally never really focused on that much before. Now we all have to start thinking about this a little bit more. There are some exceptions to this, so I've summarized this. There are actually other ways it can happen. So for example, employees are required to report to their employer all the tips they receive. They have a weekly or monthly or whatever it might be reporting requirement to report the tips that they receive to their employer. If there's a difference between what shows up in box 7 and that number, you can use that other number. The reason that wouldn't be true is because their wages exceed $176,100. If you've got clients in that category, good luck. I'm not going to tell you how that works. Certain government employees or religious group employees are also exempted from those rules. I don't think they're going to be likely to be receiving tips. So this was just my way of simplifying these because it gets really complicated. So that's part of what I do, is try to kind of make it focus on what I think is the vast majority of what we're going to see. There could be exceptions to this where you'd have to look at some other document, but I think that's very unlikely in the case of Vita clients. For non-employees, the tips received by a sole proprietor but not included on a 1099 are not deductible under the tip deduction rules. The tip income has to be shown on a 1099. This is going to be a big surprise, as we're going to talk about in a bit, for like Uber drivers. So I'm going to come back to that one. Some documentation should be available to support the amount of the qualified tips. This is the IRS's, I've paraphrased it, but this is their suggestion. So for non-employees, there's got to be some documentation to support the tip deduction. That can come from the payor, and come from a third-party system, like a credit card system or something like that, or records maintained by the taxpayer. Notice states that the amount of qualified tips for non-employees should be calculated, quote, using earnings statements or other documents such as receipts, point of sale system reports, daily tip logs, third-party settlement organizations such as credit card companies' records, or other documentary evidence that corroborates the calculation of the total amount of qualified tips. We'll see what we get from our self-employed folks, but I think this is going to be a bit of a challenge. I'm hoping, this is a hope, that like the Ubers of the world are going to tell them how much is tips. I'm hoping. I'm not saying they're doing it. If they don't, then God only knows how we're going to come up with what this number is. I mean, and we're going to talk a little bit more about that later. The amount of the deduction cannot exceed the net profit from the business. So again, we're talking about self-employed people. There is a limitation on the deduction. Basically, can't be a negative, can't throw you into the negative. So it will be capped. Instead of getting the full qualified tip deduction, it's going to be capped at the profit of the business if you're self-employed. So for employees, I think this is actually, the calculation part is fairly straightforward for our client base. Again, some people make a lot of money, make over 176,000, or certain religious groups and state employees, it would be a little bit more complicated, but that's not people we're likely to see that are reporting tips. So if they're reported, they should appear in box 7, Social Security tips. Again, we're going to walk through all this tip reporting stuff in a minute. If they're not reported, or they are what's called an allocated tip, which I'm going to come back to that in a bit, they have to be entered on a Form 4137. So this is the form that employees use to basically pay the employment tax on their unreported tips. And those can either be because they're truly unreported or because they're what are called allocated tips. So this is the way employees self-report the employment tax on their tip income that hasn't been reported to their employer. The tip deduction would then offset the income, but leaves the tip subject to Social Security and Medicare. So does that make sense? So for employees, I think it's going to be pretty straightforward. It's either going to be in box 7 or it's going to be on a 4137, and I'll show you how that works. But so I think that should be pretty easy. Now, again, that was the tip qualification requirement. I think that part's fairly easy. We still have the other requirements that I talked about. The most important of these is confirming the occupation is on the occupation code list. You can ask about the other requirements, but I think we're left with taking the taxpayer's word. So one great example of this is, did you get it as a voluntary tip or did you get it as a service charge? I will be shocked if you have any taxpayers that can tell you, oh no, that was the 18% service charge on a party of 6, so I don't get to deduct that part. They're going to say, it's all good. But we still have to ask. I mean, so in a minute, I'm going to give you a little checklist for the tip deduction to be able to ask your taxpayers or for you to think about when you're interviewing somebody about tips. So again, the calculation I think is pretty easy, but we still have to worry about the taxpayer requirements and the qualification requirements to make sure that it's a qualified tip. For non-employees, we'll be characterizing a portion of their income that's reported on a 1099 as tip income, which will generate the tip deduction. So I think this is the greatest opportunity for abuse because unlike employees, it's going to either be in a box 7 that the employer reports or the employee is going to voluntarily report it on a 4137. Here, you're just saying, okay, I got this 1099 for 10,000 bucks. 8,000 of that was tips and 2,000 was not tips. So obviously there's lots of opportunity for people not reporting correctly here, which I think then puts a little more burden on us. So I think we should ask for documentation to support the amount of the tip income that's included on the 1099 and then ask them about all the tip qualification requirements. What about ride sharing and food delivery drivers? Which we all see more and more of these every year. So let's start with food delivery drivers because I think this one's pretty straightforward, such as drivers for DoorDash or Uber Eats. They are supposed to receive, my understanding is, they actually get a 1099 NEC if they're paid more than $600 by the food delivery service. So we're going to see the rules are much different between how the payors deal with food delivery versus they deal with Uber driving for ride sharing. So here, if they pay them more than $600, they're going to put it on a 1099 NEC. So we'll have a 1099 NEC. Then we get into the whole issue about how much of that is tips. Hopefully they will give you some information. DoorDash actually said on their website, they intend to issue a statement to their drivers detailing the amount of qualified tips they received during 2025 while driving for DoorDash. Thank goodness for DoorDash. So they're actually going to provide us that information. So if you've got a DoorDash driver, you want to make sure that they're providing that information to you so you can see. I've not seen anything about Uber Eats, for example, yet, so I don't know whether they'll be providing that information, but hopefully they will. The issue, of course, will be cash tips. This will probably not be included in the amounts reported by DoorDash, but then again, who reports cash tips? So that's my cynical way of, I don't think that's going to be a big problem, but again, if it's a cash tip, it's not in the 1099 NEC, it's not a qualified tip anyway. The bigger problem is rideshare drivers. And this was kind of a surprise, particularly when you think about it in the context of what they did to 1099K. So these workers are not providing service to Uber, but to the customer in the view of Uber. So rideshare drivers are typically not treated as employees, as we all know, and they don't receive a W-2. In addition, these workers often don't receive a NEC, a MISC, or a K. For example, this is language from Uber. Uber says they only issue a 1099 NEC for non-ride earnings, such as promotions, referrals, and other miscellaneous income, but not for the regular charges and tips received by drivers. So they're not going to issue a 1099 NEC for the ride share income. The 1099K reporting requirements have now, we've been talking about this every year for the last few years. I've been telling you, they've been cranking these down. Well, now they're going back up. They went back to the 20,200 transaction rule. So all the Uber drivers who had been or would have been getting 1099Ks, now we're going to go back to the old 20,200 transaction rule, which some of you probably see Uber drivers who are going to hit that threshold. But unless the driver hits that threshold, they're not going to get a 1099K. They're not going to get a 1099 NEC reporting their rideshare income. The tax summary that they get, we all are familiar with, Uber gives you a tax summary at the end of the year. The reason they're giving you that is because they're not required to report it to the IRS because you didn't meet the NEC requirements or the 1099K requirements. So that tax summary that people bring in, if they're Uber drivers, is not a 1099. It's not reported to the IRS. And I think, unless somebody tells me something different, Uber drivers aren't going to be able to take the tip deduction unless they get a K. So I think this is going to be a big surprise to our Uber drivers. Now, JD, where are you sitting? JD is back there. JD, I introduced him last year. He's the boss of the Camp Lejeune site. So they are, he's got 20 approximately Marines working for him who do taxes. I help him do their training every year. They do a lot of returns. They did over 6,000 returns last year. So they dwarf all the rest of us in terms of one site, what they pump out. They see a lot of Uber drivers, a lot of the military as a part-time job. They go off and do Uber. I asked him this morning about this. He said sometimes they see people who earn less than the requirements still get a 1099K. They may have earned $1,000 and they'll get a 1099K. I'm not sure why, but they'll see other people who are over the threshold who never get a 1099K. So I'm not sure how Uber is doing that exactly, but this is really concerning because of the bump back to 20,200, that we're going to have a lot of Uber drivers that are not going to be able to take their tips and they're not going to be happy. One thing to remember about this tip deduction, it's not on Schedule C, so it has nothing to do with their Schedule C income and self-employment tax. This is a tax computation impact that it has, income tax computation. Any questions on Uber? Anybody disagree with me on that, by the way? Because I'd love to hear somebody tell me I'm wrong. Okay, hearing none, we're going to move on. So this occupation list that we've been talking about. So the term qualified tips means cash tips, including those charged on a credit card, and tip sharing arrangements. That's where like a restaurant will charge a tip that they share with like the cooks and the dishwashers and all that stuff. That's called a tip sharing arrangement. Has to be in an occupation that customarily and regularly receive tips on or before December 31, 2024. The Treasury Secretary has actually issued a preliminary list of such occupations. It's called the Occupation Code List. The list is quite broad, so anybody who works in a restaurant is generally covered, including cook, staff, and dishwashers. Other examples include gambling workers, digital content creators, hotel workers, landscapers, home cleaning, repair workers, nannies, personal service workers, transportation providers, tutors, travel guides, and golf caddies. So it's a pretty broad list of people who are qualified for receiving tips. The list is broken down into 8 categories. So these are the various categories. One of the handouts you should have received is the occupation code list. So if you got that, I'm going to borrow yours for a second. It looks like this. So it's pretty straightforward. It's just a list of front and back of the occupation code list that was issued by the Treasury. That will tell you whether or not somebody has that it meets the occupation code requirement. Claudia, do you have the microphone still? I have a question. This gentleman right up here.
I don't do Uber. So the issue comes up is I understand it. You request through Uber for a driver, and then a driver arrives and you pay Uber through your credit card. And if you tip through your credit card. So Uber or these ride share, they have all that information is what the tip is, but they're not going to provide that information. Is that what you're telling me?
I don't know the answer to whether they'll provide it. The big problem with Uber is if they don't put it on a 1099K, it's not deductible. Doesn't matter that they actually receive tip income. That's not going to be deductible tip income.
Okay.
Because it's got to be reported on a 1099K. So what you're going to need really is two things. You're going to need a 1099K from them showing their Uber income, and then you're going to need that separate statement that then tells you how much of that 1099K income was tip income versus just the regular charge for the ride.
Okay. A second question is restaurant workers.
Yes, sir.
It's my understanding in a lot of restaurants where the waitress or waiter will be tipped, cash or credit card or whatever. But they share that with the cook, the dishwasher, and this type of thing. It goes
Yep.
in a pot and everybody. How is that calculated? Because if it's put on a credit card for that one person, that one deal, or how, I don't understand how that's going to be handled.
Join the group. So, for next year, the employer, I'm guessing if they have, some restaurants have very formal tip sharing arrangements where it's like, okay, you got to give 10% of your money to the hostess and you got to give 10% to the staff and that kind of stuff. If they have a formal tip sharing arrangement that the employer knows about, they should be reducing that credit card amount that went to the server by the amount that then had to go into the tip apportionment allocation stuff. But for this year, maybe they'll get that information. My bet is we're not going to see that a whole lot. So but that also raises another issue that I do not know the answer to, which is if you report tips to the employer, I don't know if maybe anybody here knows the answer to this. Is it net of if they have to share with other people?
Our son is in.
Okay, hold on just a second. Wait for the microphone because I don't want to have to repeat it.
Thank you, ma'am. Our son is general manager in high-end hotels.
Excellent.
And restaurants, and they do have most restaurants, even the lower end ones, have a percentage that goes to the bartender, the hostess, and each.
Yep.
So even if it's on one credit card, it's $150 tip, that doesn't show up for that one employee. It is divided by percentage amongst each of the.
Okay. So hopefully what's showing up in box 7 is what went to the service provider, the server, so that the employer is making that determination. Obviously, we're not going to have the information to do that, but hopefully the box 7 is going to fix that for employees. Any other? Yes. I'm sorry. Yes.
So if an employee comes in and it has that amount in box 7, showing how many tips they have, and they say, that's not all, I didn't get all those.
Yep.
What do we do?
What do you think we should do?
Just use them on a box 7 or tell them to go someplace else?
Well, that's the easy answer is, hey, they put it on box 7. It's included in box 1. Basically the employer is saying, you got this as income and I'm reporting it in box 1 because anything that's in box 7 is included in box 1. If that's wrong, I would say you need to go back to your employer and get them to issue a revised W-2, which we know is never going to happen. So that's one where I would not everybody has to make their own decision. I personally would not accept a different answer than what's in box 7. I would make them go back and get a revised W-2. Yes, sir.
On a self-employed person, You can only use it that's on a 1099. Let's say half their income is from cash. You can't use that part of it.
That's correct. Yep. So anything that they get in cash, first of all, are they going to report it as income, which would then allow them to get a deduction? But they, even if they're honest people and they report as income, it doesn't qualify for the tip deduction. So my bet is we're not going to see a whole lot of cash tips being reported, but maybe there are some honest people out there who will report them. Okay, so that occupation code list, the reason I gave you that as a separate handout is because I strongly advise that you just have that for all your preparers and that they show this to the taxpayer if you're doing it face to face and say, you know, obviously if they say they're a waiter, that's easy. But if it's something where you're not sure, make them look at that list and tell you, yeah, that's what I am. I'm this person. Okay, that's fine.
Hey, Bill.
Yes.
So we are getting some information that folks are putting questions in the chat.
Okay.
So I just want to know, when do you guys want to address them?
I would, if it's okay, I'd like to hold that. I'm sorry? Okay, so we've answered some. I'd prefer to get through the tips and then we'll take questions from
Yep.
Zoom.
So
Thank
for
you.
the people on Zoom, we see you, we're coming to you.
Okay, the notice for taxpayers also addresses the issue of whether the taxpayer is in an occupation that qualifies. For 2020, I'll jump to 2026, the employer or payor has to provide that occupation code. So next year we'll see, they'll say it's occupation code 101. So you'll just know automatically it's good. We don't have to think about it. For this year, what the notice says is the taxpayer is responsible for determining whether the tips were received in an occupation that customarily and regularly receive tips. So that's why I say, just have that sheet available, make them tell you, yep, it's one of these, and you take their word for it. Because obviously we're not going to get into a big fight with them about, are they actually this kind of employee or whatever. Employers may choose to provide this information using box 14 of the W-2. This is from the notice, in which case the employee can rely on that information. So if the employer tells you in box 14 this year, which is a voluntary thing for employers, but if they choose to tell you what the amount of tips were and what the occupation code was, obviously we get to rely on that. Now there's another whole complexity in all of this that pre-notice was scary about what are called specified service trade or businesses. This comes from, we have this currently, although we never talk about it, with section 199A. So qualified business income, there's certain professions that are not allowed to have qualified business income. They're also not allowed to have tips. And that is basically largely lawyers, accountants, doctors, entertainers, people that are higher paid, people that those professions. There's a whole infrastructure around the definition of who's in a specified service trade or business. But for 2025 and possibly some later years, because of the way they stated it, the notice states that the IRS will treat the taxpayer as having received tips in the course of a trade or business that is not a SSTB, as long as the occupation is listed on the occupation code list. So basically we get to ignore SSTB for this year. And that's equally true because that SSTB requirement won't come in until the regulations that implement that are finalized, which that may be next year, it may be the year after, who knows. So we only need to worry about the occupation code list. So I just put this on here because I know some of you have seen stuff about this whole issue around specified service trade or business, about how employees fall into that and all this, a lot of complicated rules. We don't need to worry about those for this year. So again, I think it falls on us. I say, show them the list, get them to tell you, yes, I'm one of those people. So in conclusion, well, it's not really a conclusion because I'm going to keep talking about tips for a while, but the taxpayer requirements and the qualified tip requirements will be based on information provided by the taxpayer. For employees, the calculation requirements should be very straightforward, as the tip should be in box 7 or reported on a form 4137. In my view, it's only with respect to non-employees receiving tips that are reported on a 1099 that we're going to have a difficult decision to make with respect to what kind of documentation we're going to require. And really, this is a site-specific issue. I can't tell you what you should or shouldn't do. I can tell you what I think is one way to do it, but I'm not completely clear on this. So if they come in and they tell you, if they're a self-employed person and they say, yeah, I made X amount and it's a tip occupation, am I going to fight with them about, well, you got to prove how much of it was a tip or not? I wish there was an easy answer to that, but there's not. So you're going to have to kind of figure out for your own site, because I think it's easy to say, do I talk about this? No. It's easy to say, hey, it's taxpayers' tax return. They're signing under penalties of perjury. That's their problem. I'll remind them of that. And because there are lots of issues we currently have where that's the problem is, we all know Schedule C expenses. Do you guys get receipts for all the Schedule C expenses? No, I bet not. You're taking the taxpayer's word for it. That's always a great opportunity when you get to something like that to remind them, you are signing the tax return under penalties of perjury. You have to be able to prove, the burden is on you to prove this to the IRS if they ever come calling. Same thing is true with this. So I think that's one approach, is just say, taxpayers' tax return, it's not my job to second guess it. And we're going to talk about this later. I personally think there's a difference kind of between factual questions and legal questions. I think this is more of a factual question that we really don't have either you tell them, I'm going to take your word for it if they don't have information, or you're going to tell them we can't do the return, go to a paid prepare. Does anybody have another thought on an in-between? I just don't know what else to do. Yes? Kara? Got the microphone? I'll take it.
I wondered if there's a percentage that you say, gee, if it's more than 20% of the income, then that's a flag.
Red flag. That's an interesting thought. Again, I think that's a site-specific decision about whether that's something you'd be comfortable in saying. But I think there's some, your son would know all about this. People in the food service industry, if they work for a high-end restaurant, their wages are a small fraction of what they make. They're making 90+% in tips. So to say, hey, if it's above 20, I don't believe you, it's like, well, that's not really true for people in the food industry. So I guess I would say I'm probably not real comfortable with that. But, again, I think with everything else, if it just doesn't sit well with you, it's like, Claudia, you may want to comment on this, but my feeling has always been, if it makes you really uncomfortable, then you tell them we just can't do the return. But otherwise, I think we take their word for it. You want to comment on that?
Yeah, and you're exactly right. And just as a reminder, nobody's an auditor in here, right? We're all just Vita volunteers. So you explain it to them as it is and say, here's what we've got. But here's the thing, you always have the right to say, we do not feel comfortable doing that return. Okay, you always have that right. So agree.
Okay, thank you. Okay, so this is my little quick tip checklist that I suggest, if you're so inclined, print this off and kind of keep this handy so that when you get a tip question, you just kind of run down this list, either mentally or actually, to be comfortable that, yeah, this is a qualified tip. And it's that last one that is the big question mark. So let's look quickly at TaxSlayer, and then I'm going to stop to take questions before I get into my little tip primer for you. So TaxSlayer, for those of you who've been in TaxSlayer, you've probably already seen this, but there's this new section in the deductions called additional deductions. So that's where the overtime tips, tax on car loan interest is. Senior tax deductions aren't there because TaxSlayer's calculating that automatically, so it doesn't require any inputs from us. We click on no tax on tips, and we're going to see this. So it's going to say, what are my qualified tips included on W-2 Box 7? What's on the 4137? And what's on an NEC? There's no input required for occupation code. So I don't quite understand why the IRS is so excited about the occupation code list and knowing what the occupation code is, and then they don't require it to be on the tax return. So we're going to see taxpayer doesn't ask for it, doesn't go on the tax return. So again, not quite sure why there's so much about the occupation code list. I mean, obviously you need to make sure that it's a qualified occupation, but that code doesn't go anywhere at this point. Maybe next year when they kick that in for employers that they have to report that, maybe they'll put in an entry for the occupation code, but that's not there for this year, at least not so far. Schedule 1A, so here's the section on tips. It's part 2. So you'll see right here at the top. Only if you receive qualified tips. These tips must have been received in an occupation listed at blah, blah, blah. You and or your spouse have received qualified tips must have a valid SSN. If married, you have to file a joint return. So see, they don't really like that language, but that's what they chose to say. So they're just telling you kind of what the requirements are again. So that's the only time we see anything about occupation code is up in that comment section. Then we get down to here. This is for employees. So 4A is where the employees shown in box 7 is going to go. The next line 4B is going to be employees reporting on a 4137. Then down here, we're going to see this is our NEC miscellaneous or 1099K. It'll be where that shows up. And then here's our $25,000 limit kicking in. And then here's the income phase out in the form. Okay, I'm going to stop there, see if you guys have any more questions, but we can also open it up to questions on the.
I'm going to start right here.
Okay, hold on.
Okay, hang on. And I'll just sort it around the room.
Okay.
Hey, so when we are entering on like in TaxSlayer on the W-2 and we fill out box 7, is that going to carry over to that other section?
I'm going to talk about that, but no, it doesn't.
Okay.
You've got to manually enter that.
All right. Thank you.
Yep. There's a microphone coming behind you.
So the taxpayer may have to fill out the 4137.
We're going to talk about that when I go through the tip primer.
Uh-huh.
I'm going to show you how the 4137 gets created.
Are we going to have to provide them a copy of that?
It'll be in the tax return.
It'll be in.
It's actually a form that goes in the tax return.
Okay.
It's in TaxSlayer.
It's in
So I'll show you in a
TaxSlayer.
second.
That was my question.
How that
Thanks.
works. Yep. Kara, you got anything? Nothing else? Okay, good. All right. So as I said earlier, I've learned a lot about tips in the last 5 months. So I'm going to share that with you guys. So this is my attempt to simplify the reporting of tips and how to report the various types of tips in TaxSlayer to be able to take the new tax deduction. Now, again, most of the time, this isn't going to be relevant. This is when you get into unreported tips, allocated tips, those kind of things. This is where it gets complicated, which you may or may not ever see this. So this is the W-2 reporting of tip income. So I thought it'd be helpful to kind of walk through the W-2 boxes to say, is tip income in this or is it not in this? Because sometimes it is, sometimes it isn't. Box 1 should include wages as well as tip income reported by the employee to the employer. That's always been the rule. So tip income ought to be in box 1 of the W-2. Box 3, which is called Social Security wages, should exclude any tip income. So tip income that's reported by the employee to the employer is not in box 3. It's their other compensation from the employer is in box 3. We're going to see where the tip income comes back later. So the box 4, the Social Security tax computation that TaxSlayer does for us automatically, it computes the Social Security tax on the sum of 3 and when we get to it 7, which are the reported tips. That's why we always get the warning from TaxSlayer. If you have reported tips in box 7, it gives you a warning like, wait, the Social Security calculation is off. That's because TaxSlayer is doing it exclusively based on box 3. It's not looking at box 7. Box 5, Medicare wages, does include tip income. Again, trying to make this as complicated as we possibly can. So box 3 excludes tip income, box 5 includes tip income. Box 7 reports the amount of tip income reported by the employee to the employer. Again, there are exceptions for non-covered employment, wages greater than $176,100. I don't think those are worth worrying about for our purposes. So box 7 is really the key box for us, which is if you see a W-2 that's got amounts in box 7, that's our trigger for that should be a good, at least it meets the calculation requirement for the tip. We still got to worry about all the other requirements. No, it is. This has always been the rule. So this back button doesn't work. I apologize. But the reported tips has always been in box 7. And so there's no change from prior years. Now, box 8 is the one that I don't know how many of you see these, called allocated tips. Anybody remember ever seeing one of these? Okay, so I'm probably going to waste a little time here to talk about allocated tips just in case you ever see one. I'll go through this quickly because it sounds like I don't remember ever seeing it, but I don't do a lot of returns these days. But I just want to tell you what they are so that you've got the handout again that'll help you understand it if you've got allocated tips. So those show up in box 8. And what that is certain employers in the food and beverage operations are required to compare the amount of tips that are reported by their employees to an amount equal to 8% of the employer's gross receipts. If the reported tips are less than 8%, the employer has to allocate the 8% across the tip receiving employee base. And for anybody who didn't self-report at least that much, that gets reported as an allocated tip. So it's basically a way the IRS is making sure that people are really reporting at least 8% of the employer's gross receipts are being reported as tips. And again, this is just for food and beverage operations. This doesn't apply to any other business. So the amount shown in allocated tips in box 8 is not included in box 1 or box 7. So this is a separate calculation that the employer makes. It doesn't go in box 1, it doesn't go in box 7, which means it's not included in income, it's not subject to Social Security tax yet. However, the employee is supposed to include this amount in income and pay employment taxes thereon unless they keep records to show the actual amount of tips received that they did not report is more than or less than. So what box 8 is setting up is a proxy saying, if you can prove this is wrong, then prove it, and we'll let you report that, and I'll tell you how you do that. If you can't prove it's wrong, you have to include that box 8 amount in income. So for reporting tip income on the tax return, if an amount's entered in tax layer in box 7, no additional steps are required to report the income because it's already in box 1 and it's already in boxes 4 and 6 for the employment tax computation. So box 7 is easy. All we do is put in on the W-2 what's in box 7. Tax layer takes it from there for the income side of it. If an amount shown in box 8 for allocated tips, now you've got to do extra work. So either you have to report the amount in box 8 as tip income, or if they have records to support a different number, you have to deal with that. I'm not going to go through this in detail because, again, I don't think anybody's seen this very much, but this tells you if you have an allocated tip, how do you enter all that stuff into tax layer? And it's going to then generate the form 4137 for you. So when you tell it, I've got unreported tips or I've got allocated tips, depending on where you put that into tax layer, it's going to create the 4137 for you. So it creates that 4137 we need in order to claim the tip deduction for us. So if it's a truly unreported tip, there's a box on the W-2 input page in tax layer that says unreported tips. I can't back it. But again, so all that goes into how do you report it if you have this allocated tip situation, which it doesn't sound like many people ever see. So you'll have the handout if you ever see one. So what about the new tip deduction at tax layer? So at this point, at least the last time I checked, tax layer is not carrying over any amounts to the tip deduction input page. So, gentleman's question here, amounts entered in box 7 of the W-2 do not carry over to the corresponding tip deduction entry. You have to manually enter that. So that where I showed you before in tax layer, where you go to do the additional deductions, tip deduction, those entries, tax layer's not pre-populating those for you. You've got to manually put those numbers in. So qualified tips include on Form W-2 Box 7, you'd have to enter that $1,000. If there are allocated tips shown in Box 8 or unreported tips reported in the unreported tips box, those amounts also don't carry over. You have to put those in as well, and I've told you how to do that. It gets really complicated if you have stuff in both Box 7 and allocated tips. I'm not going to go through this page. Just know it's there for how you do that. So the bottom line is you need to be really careful, make sure that the amount of the deduction equals the amount of the qualifying tips. Again, this is the complications of those. So this is an example I gave of allocated tips. I'm not going to go through that. I'm not going to waste your time on that. Again, just know that if you ever get that, come back to this handout and it'll help hopefully answer your questions. So I'm just going to blow through all of this. It actually works really strangely. So if you do get one of those, be sure you go through this because you don't want to double deduct it, which you could if you just follow what these boxes say. So this shows you what the box 1 would look like. Again, this is the example of both allocated and Box 7 tips. So I'm not going to go through this in detail. My final response, that's the closing to tip income. So let's see if we've got any questions on tip income, and then we're going to take a break. Thank you for your patience. I have a question back here. Or you've got some?
This is just a clarifying question. They're asking if they thought that the allocated tips was what the employer pays to get the employee up to minimum wage from the 213 instead of the way that you described it. Can you describe what that is again?
I don't know that. What I went off of is what the IRS instructions say allocated tips are.
Okay.
So
ask that.
again, I'm not an expert other than what I've learned over the last 5 months. So they may be right that there's more that's going on in allocated tips. I just know what the IRS instructions say about if you've got something showing in Box 8, what do you do with it? That's what I went off of.
Good enough.
Oh, somebody can answer that? Hold on, there's a microphone coming.
The minimum wage thing is kind of an urban legend in the restaurant industry.
Okay.
The allocated tips are exactly the way you described them.
Oh, thank you.
And the calculation of that, quite frankly, goes back to the 1980s when they started trying to zero in on unreported tips. The urban legend is that lots and lots of restaurants, you'll be in big trouble with your coworkers if you report more tips than exactly what's necessary to get you up to minimum wage.
Oh, interesting. Okay. Fascinating.
So my question is with the Uber driver example where they don't get a K-1, why can they get a form from Uber that shows what the tips are, the qualified tips are?
Yep.
Why can't you put that on the 4137 form as unreported tips?
The 4137 is only for employees. So,
Oh, you can't do it if you're self-employed.
no.
Oh.
But you could put it on a Schedule C, but the qualified tip deduction says it's got to be reported for non-employees. It's got to be reported on a 1099. That's the only way a non-employee can take a tip deduction. Other questions? Nope. Let's take a 15-minute break. Then we'll jump into overtime, which is even worse.
While you're on your break, for those who remain inside, who don't go out, I have a little giveaway, only if you can answer the question. Okay. Question. I'm a married woman who has a missing husband. Haven't seen him in a while. I have 2 young kids. What's the best status I can claim on my tax return? Head of household. Thank you. I'll remember that. Here you go, dear. Okay, my next one. What's the name of the publication that you need to get certified? All righty. Got to remember that too. 6744. Okay, here's another one. Okay, I work and I have a young child and I have an 18-year-old. For me to go to work, I pay my 18-year-old to take care of my young one. Can I claim? Yo, I can't catch everybody. Raise your hand. Okay, caught yours first. For the rest, can I claim adult child expense? Okay, everybody knew that. All right, I'll let my 18-year-old know that he's not really helping me. Okay, child tax credit. Raise your hand. What's the maximum amount for child tax credit for 25? Okay. The amount of child tax credit was what? Total. All right. For someone else, what is the refundable amount? Okay, got you. Oh, okay. What is that I gave out? 1, 2, 3. Well, what you need? Do we have any more of the handouts? Okay, one more, then I can let y'all go. What is the minimal income for child tax credit? All righty. Oh, y'all can go now. Okay. We'll play some more later.
Yeah, I already did mine.
Thank you. You're welcome.
They all have any more of the book. Man. At least 2. Get going again. We're on a tight schedule here. Recording. Okay, let's get going. Sorry, folks. I love that you get the chance to talk, but we also got a lot of material to get through. So I got 2 questions, comments during the break that I thought were interesting that I wanted to pass along. One of them was a great question. We're going to see it when we talk about itemized deductions later is, okay, we just went through all this headache of tips. It's going to get even worse when we talk about overtime. Lots of groans there, boy. But the point is, if you do the return without doing the tips deduction or overtime deduction or whatever, they don't owe any tax. Don't bother, because it's not going to make any difference. I mean, you go through all this stuff for nothing. So one way to think about it is if it's a difficult tip overtime question, do the rest of the tax return, then go and look at the tax return. I'm going to tell you what lines to look at later on when we look at itemized. See if they owe any tax. If they don't owe any tax, don't bother. It's not worth going through it. Or you can put it on if you want to. Just don't get too upset about it, whether it qualifies or not, because it's not going to make any difference anyway. But the other one was a great point about Uber doing the right thing. This might be the first time it's ever happened, from what I hear from Uber drivers. But if Uber was doing the right thing, they would issue everybody a 1099-K. They're not required to, but if they want to do the right thing for their drivers, they'll issue 1099-Ks even though they're not required. So hopefully that'll come to pass, but obviously none of us know at this point whether Uber, Lyft, or anybody else is going to do that. But that would solve our problem with the rideshare. Okay. No tax on some overtime. So once again, people's perception of what this is going to be and the reality are not the same. Much like the tips deduction, we add a new temporary deduction for certain overtime pay for the years 2025 to 2028. Again, you don't need to itemize to take this deduction. The rules are quite complex, particularly for 2025. We will see once again. Lots of limitations. The maximum deduction here is $12,500, $25,000 on an MFJ return. So you're going to see every one of these deductions has totally different rules about what the limits are, what the income phase outs are, and everything. Here it's $12,500 or $25,000 on an MFJ return. There is not a per taxpayer limit on an MFJ return, so one spouse could deduct the whole $25,000, which is kind of interesting. The maximum deduction begins phasing out for incomes here above $150,000, $300,000 on a joint return. Once again, we have to have a valid SSN. Just like the senior tax deduction, the tip deduction, a married taxpayer must file a joint return or qualify for the head of household, so married filing separate cannot claim this deduction. Any amount deductible as tip income can't also be deducted as overtime pay. That's kind of self-evident, but again, it's going to be subject to Social Security Medicare tax without regard to whether it qualifies for the deduction. So you're not avoiding employment taxes, only income tax here. Okay, so qualified overtime compensation. So for purposes of this deduction, it's determined, you're all going to become labor lawyers here. It's determined solely by reference to the overtime pay rules prescribed by the Fair Labor Standards Act. If overtime pay is not required to be paid by the FLSA, it is not deductible. For example, if the overtime pay is required by state law, but not the FLSA, it is not qualified overtime compensation. It has to be required by the Federal Labor Standards Act. So I'm going to thank ChatGPT for this following summary. It's actually it's a great tool. I mean, I'm pretty amazed at what it can do. So I asked it to summarize for me the FLSA rules. This isn't word for word what it said, but this is generally where I got this from because I am not a labor lawyer. The FLSA overtime rules cover almost all hourly workers, except for certain computer workers, outside sales employees, and commission retail service employees. Salaried employees are generally covered unless they earn more than a dollar limit, $684 a week or $35,568 for the year. And they fall into kind of one of the white collar professions, which are, there's a whole bunch of rules obviously behind all of this. Executives, administrative employees, professionals, computer employees, or outside sales employees are not covered by FLSA. So again, virtually all hourly people are, and salaried basically if you're making more than 35,568 and you're in one of these groups, you're not subject to FLSA. Otherwise, you're covered. While it's possible that a taxpayer can be treated as subject to the overtime requirements of the FLSA, but be an independent contractor for tax purposes, this happens, my understanding is extremely rarely, and is usually the result of litigation. They sue the person who's they're providing the service to, saying you owe me overtime, and so they have a big fight about that. While you could ask someone receiving a 1099 if they're treated as an employee for purposes of FLSA overtime rules, I personally find it hard to believe that the payor would admit that the overtime rules apply if they're treating them as an independent contractor. So in my view, overtime deduction rules are only going to be an employee issue. Don't have to worry about this for independent contractors. If the employee is subject to the FLSA overtime rules, they have to be paid time and a half for any hours worked over 40 hours a week. The employer can choose to pay more than time and a half, but the FLSA only requires time and a half. The amount of overtime that is deductible is limited to the amount required to be paid by the FLSA in excess of the regular rate of pay. So this was another bit of a surprise to me based on what you heard in the campaign versus the reality. So to illustrate the point, taxpayers paid $20 an hour as his regular pay. Whenever he works more than 40 hours in a work week, he's entitled to $30 an hour. It's that $10 difference, which they call the overtime premium, that is the amount that's deductible. It's not the total overtime pay. So it's not the $30 an hour saying, hey, all your overtime pay this year, you get to deduct it. It's only the premium that you got for the overtime period. How many people is that a surprise to? Okay, that's kind of what I thought too. So that's one problem. If the employee receives a higher rate of overtime pay than time and a half, such as double time, only the amount required by the FLSA is a 50% overtime premium is deductible. So using the prior example, taxpayers pay $20 an hour, but if he works overtime on holidays, gets paid $40 an hour. Because FLSA only requires that he be paid time and a half, the deductible piece is only $10 an hour, even though he actually got paid $20 an hour. You're already kind of seeing where there's going to be a little complexity when we get into how you calculate this thing. So again, it's only what's required by FLSA that counts. The fact that deduction is limited to 50% is going to be a surprise, I think. So another opportunity for unhappy taxpayers. The exercise will get much easier next year, again, because the employer is going to be required to report the qualified overtime compensation. So next year, we don't have to worry about all this stuff. Unfortunately, that's not the case for this year. So those same notices that came out on tips also talked about overtime rules. So the notice that was to the employers says that overtime pay has to be included in box 1, which should have been anyway. In addition, just as with the tip provision, employers are encouraged but not required to provide separate accountings of overtime compensation so that the employee can properly report the overtime deduction. So I have to say, coming into this, I thought the tip one was going to be harder and the overtime would be easier. I've now changed my perspective on this. The notice goes on to state employers and payors can make such information available to their employees and payees by including it in box 14 or through an online portal, additional written statements furnished to the employees or payees or other secure methods. So one thing to be careful about, because I know in my own training at our site, I usually tell people, you can kind of ignore what's in box 14. If you're in North Carolina, there's very seldom does box 14 have a lot of impact. It's not a 100% rule, but most of the time you can ignore it. Don't want to ignore it this year because you may see overtime information in there or you may see tip information in there. So always check box 14 this year. So the second notice, taxpayers also had rules about qualified overtime. It says that the amount of qualified overtime compensation received or a separate statement from their employer with this information must make a reasonable effort to determine whether they are considered FLSA eligible employees, which may include asking their employers about their status under the FLSA. So that's the first, is they got to make sure that they are an employee that's covered by FLSA. That burden is on the employee. In determining the amount of overtime that qualifies, employees are allowed to rely on information in box 14 or a separate statement that provides that information. Of course, if that's provided, that's great. If it's not provided, employee has to determine the amount of overtime on, quote, other documentation such as earnings or pay statements, invoices, or similar statements that support the determination using a reasonable method to determine the amount. I think the best source of this is going to be the final pay stub for the year. So we're going to be asking people to bring in, if they want to claim the qualified overtime, I think you're going to, unless they get some kind of separate reporting from the employer, you're going to want to see their last pay stub that shows the year-to-date compensation, because typically that's going to break out overtime payments. Notice provides guidance and examples on the types of information that might be available to an employee and can be used to determine the amount of qualified overtime compensation. So here's where the calculation complexity comes in. So this is examples that are very similar to ones that are in this notice. And instead of talking about the rules, I decided the examples were a better way of explaining it. So here are the examples, and these are very similar to what's in the notice. So taxpayer receives time and a half for overtime work. Their final pay stub for 25 shows that the taxpayer received total overtime premium. So again, the overtime premium is the amount in excess of regular pay of $1,000 for the entire year. Employee is able to take a deduction for $1,000. So if the final pay stub shows here's what the overtime premium paid was, you can use that number. I think this is going to be the more likely one. Facts are the same as one, except that the pay stub only shows $3,000 as the total amount paid for overtime, both regular pay and overtime premium, but it doesn't separately state the overtime premium. In that case, the deductible amount is 1/3 of the total overtime pay received, $1,000. So it's basic, here we got to do a calculation. So they got paid time and a half. We know, hopefully we know they got paid time and a half. We know the total compensation paid to them for overtime was $3,000. In that situation, we know that 1/3 of it would be the overtime premium that's deductible. Make sense? Okay, let's make it more complicated. Taxpayer receives double time for overtime work. So the employer chooses, instead of paying overtime and a half, it pays double time. Taxpayer's final pay stub for 2025 shows that the taxpayer received total overtime premium of $2,000 for the entire year. FLSA only requires payment of time and a half, so only 1/2 of the overtime premium is required to be paid under the FLSA and is deductible. Okay? This is where I'm going to come back to the practicalities in a second. Let me get through the rules and then we'll talk about what all this means. So the facts are the same as in 3, except that the pay stub only shows that the total amount paid for overtime was $4,000. Doesn't separately state. Here, because the employer pays double time, $4,000 represents $2,000 for regular rate pay, a $2,000 overtime premium, but because it's double time instead of only 50%, use half of that, or 1/4 of the total. So these are easy from a computational perspective. Not so easy. So I'm going to come back to this slide in a second. Sorry. This thing, like I said before, it won't reverse. So the problem is, that's great if you have a great set of facts. So the employee knows I get paid time and a half, or I get paid double time. And it was the same all year, nothing changed. It's not something where, hey, if I work overtime on a holiday, I get double time, but if I work overtime on regular shifts, then I just get time and a half. That's where the complexity comes in. And the notice doesn't provide us any real assistance there. It just assumes that it's time and a half the whole year, or it's double time the whole year. Then it's pretty easy to figure out how to compute it. It's the ones where What if they tell you they did both? They got some at time and a half and some at double time. That's where it's going to get complicated. If the employee receives overtime pay at a multiple of regular pay, but the employee doesn't have a statement from the employer that aids in computing the amount of overtime comp, notice says that the employee may use a, quote, reasonable method that takes into account the regular rate paid to the individual by the employer, or a reasonable approximation of this amount, and to the individual's hours of service in excess of 40 hours a week, or a reasonable approximation. They don't have records for purposes of determining the amount of qualified overtime. So what this is telling us is, if we know that they're paid on some kind of a multiple of overtime, and they don't have a pay stub that shows us how much was paid, but they know, hey, I normally get paid $20 an hour, and I worked 20 hours of overtime at time and a half this year, then we can do a computation. Again, if we're fortunate enough to get all those facts, then we can do a computation to figure out what that half overtime premium amount is based on the number of hours they worked as overtime. Oh, sorry. A reasonable method includes requesting information from the individual's employer and using the information provided by the employer for purposes of calculating the deduction. There's certain employees for whom, this is just to make it more complicated, for whom overtime compensation is determined in a different way than time and a half. So that includes private sector employees and the firefighters or law enforcement. They have weird rules about how overtime is determined. Public sector employees, so like state employees who receive compensatory time off, and employees of hospitals or certain residential care facilities, they're not subject to the normal FLSA time and a half rules. They have their own set of FLSA required overtime. So it may be, you know, if you work overtime, you get an extra day compensatory time. So what the notice then tells us for these folks is if you are in that situation, you get something other than time and a half or some other multiple of regular pay, we really have to push them to go back to the employer to get assistance with verifying that their overtime compensation was required by the FLSA and to quantify the amount. So this one I think gets really challenging. So if they get compensatory time off that's required by the FLSA, they've really got no choice but to go back to the employer and say, help me calculate this, help me figure out what the value of this overtime premium was that I got. And what the notice shows is that basically you just take a third of whatever that total overtime compensation was worth. So again, you got to get the information from the employer to say, one, that it's FLSA required, and secondly, what the total value of that overtime compensation is, and then 1/3 of that would be deductible on the return. Okay, clear as mud, right? What happens if the taxpayer claims to have nothing from the employer? This is going to be our typical case that quantifies the amount of overtime pay received during the year 2025. I think we got to push back on this one. If they won't go back to the employer or they come back and say they couldn't get anything, once again, I think this is a site question about how are you going to deal with that. The returns to taxpayers, but as with the tip deduction, you got to remind them that they're signing under penalty of perjury. The IRS clearly expects there to be documentary support. So much like Schedule C expenses, we know if they ever get audited, the IRS is going to expect to see some documentary support for that. So we need to push them to say, you really need to have some documentation to support how much of your pay was overtime pay. But ultimately, you got to figure out, what are you going to do if they say, I got nothing, I got no support. This is just what I think the number is. So this is the number I want you to put on my return. There's a question here.
It looks to me like that what may happen is we're going to ask all these questions. They're not going to have the answers. We're going to send them back to their employer. And so therefore an appointment's going to be wasted. And so we may have a full complement of appointments all filled up, and we're sending a third of those people back to their employer. And now how do we reschedule them? I mean, I just see this as
Totally understand.
do we have any, do you have any ideas about how intake should handle that
Okay.
or how the calling?
Claudia, you have a comment on that, or?
I'll just give a comment and then you can give
Well,
yours
I've got some
too.
other folks who I think may
Yep,
want
I'll
to
come
comment
down
on it
to-
as well.
Okay, I'll come down to you in a minute. But if you have the ability to do so and you know your site serves a lot of folks who have tip income,
Or
I would
overtime.
or overtime, then I'd be putting that out there as saying, this is what you need to bring if you want us to do it. So you got to message it the way that your population receives messages. That's your starting point. It could be online where you say, if you have ABCD, then this is what you have to bring in order for us to serve you, or however that method works, but you got to message it in order to be able, so that the expectation is there.
But since this is new, we won't know that really.
Well, I don't know the populations you would have served from a prior year, and if anybody recalls, was there overtime on there or anything like that? But proactively, you could easily post stuff, share stuff, say, if A, then B, this is the way we serve you.
Yeah, we do like an intake sheet addendum every year where we kind of put the things that we really care about. I can guarantee you tips and overtime are going to be front and center on that, and car loan interest are going to be front and center on that, because we're going to be asking for documentation. But you're exactly right. They show up with nothing. Are you going to then say, you got to go back, and then it complicates your whole appointment system? But again, that's a site decision about how you're going to deal with that.
I'm
Few
coming
comments
down to
down here.
everybody. Yeah, hang on, I got one right.
Okay.
Mine is more of a comment. Another wrinkle to this overtime thing is one of the key words in the statement is worked. So any non-worked time, PTO, jury duty, does not calculate in overtime. So if you have to calculate this with somebody, you need to know their non-worked paid time and not include that.
Ooh, yep, thank you.
Kim.
Needed to make it more complicated.
Mine was just for the gentleman who was concerned about them not being able to complete returns. Okay, well, one of the things that we used to do, and now, like, it's been 5 years, I'm retired supposedly, and I don't have a site, but one of the things that we did is we completed everything on the return but what we needed. Then they would call us back or contact us with the information we needed, and then we would have them just come in and do a quality review and sign. I don't know if that's something that could work in your site. I can't see who was asking that question, but that could save you from wasting an appointment or having them come back in a whole new appointment slot. Or you might even want to have in all of your appointments, you have 1 hour that you set for people to come back and do the final review after returning that last bit of information that you needed.
And that's another great example of do the rest of the return first and make sure it makes a difference before you complicate your life.
Just to follow up on what you just said, what we do is we have appointments from 1 to 3. And our preparers try to get there between 12 and 12:30. And if we have outstanding information, we ask people to come back at 12:30.
It's a good way to do it.
And it really makes a difference.
Any other comments or questions about that stuff before we go on with overtime? Okay. So the Schedule 1A, this is what the overtime section looks like. So the amount that's included in Form W-2 Box 1, there's also a box for 1099 NEC. Again, I don't think that's going to apply, so I'm not going to be worried about that for self-employed people. Here's the $12,500, $25,000 limit. And then down at the bottom, I can't back up. I need to replace this with mine. But it's, that was the income phase out stuff down at the bottom. Okay, so that's it for overtime. Not nearly as long a discussion as tips, but one that I think we're going to probably end up with more problems with trying to figure out the amount of qualified overtime. And it's all going to be a computational issue. The FLSA thing is another issue. I think taxpayers are just going to blow that off. But so I think it's the computation that's really challenging. No other questions? Anything online, Kara?
They just wanted to know if the deduction is refundable or not. Is it usable if no tax is due?
No. These are just deductions. It's not like a refundable credit like the earned income credit. Going below zero doesn't do you a bit of good. So if you don't owe tax, don't worry about it. Or if it throws you into a negative territory, it doesn't matter. It doesn't do any good.
And they're asking to what extent will tax layers do the computations?
Okay, so what you got to tell tax layer is what's the amount. So it's very easy in tax layer. You just tell it, here's the qualified overtime compensation. And then it will make a difference whether it's employee or non-employee. But as I've already blown off the non-employee stuff, basically you just be putting it in the employee section. Okay. Vehicle loan interest. This one's going to be a little easier. So we now have a new deduction for a certain interest paid with respect to the purchase of a passenger vehicle for the years 25 to 28, also available to non-itemizers. Maximum deduction is $10,000 per year for the vehicle loan interest. The deduction begins phasing out at $100,000, $200,000 MFJ. So again, all these numbers are different for every different benefit. The loan, okay, so here's the really important thing. The loan has to have arisen after 2024. So it has to be a new loan in 2025 for the purchase of a new car. Can't be a used car. Can't be refinancing another car that you bought in 24. It's got to be a new car purchased in 25 where the loan arose in 2025. Interest paid with respect to a refinance loan also qualifies if the original loan qualified. Now, that's not going to be a big issue for 25 because unlikely somebody took out a loan in 25 and is already refinancing it. But in future years, as long as the original loan was good, the refinance loan is good. The loan has to be secured by first lien on the passenger vehicle. So usually that means the lender has the title to the car. The first title has a lien shown on the title for the car. Final assembly of the vehicle has to have occurred in the United States. So we're going to talk about, this is actually not as intimidating as I first thought it was going to be. So I try to give you occasionally some good news here. Unlike the other three new deductions, MFS taxpayers can claim this one, and there's no valid SSN requirement. I'll leave it up to you as to why Congress did that, but here it's okay for an MFS taxpayer to claim it, and you don't have to have a valid SSN. I guess it's because they want to encourage purchasing cars in the US and they don't really care about anything else. Loan can't be from a related party. So if I loan money to one of my kids to go buy a car, doesn't count. Got to be a third-party lender. And here's where some complications going to come in, as we're going to talk about in a minute. Commercial or fleet vehicles do not qualify for this deduction, nor do leased vehicles. Basically, it's got to be for personal use. That's why you bought the car, is it's for personal use. Can't be a commercial vehicle. And finally, the vehicle identification number, the VIN, has to be included on the tax return. So we're actually going to have to enter that in. Great opportunity for mistakes. So, because it's a 17-digit number. So here's another Uber question that I'm going to tell you this time. I don't know the answer to this one. So what if a car is used for both personal purposes and business purposes, such as an Uber driver's vehicle? So Uber driver goes and buys a new car this year. They use it part of the time personal, part of the time business. So we're going to see the Schedule 1A, how it's set up in a second. I think you should be able to do that allocation because the Schedule 1A, I think, supports that concept. But the statute talks about it has to be purchased for personal use. So it raises the issue of, if I also use it for business, can I use it for both and still take this deduction? So that I would take the interest that's attributable to the business portion on Schedule C, I'd take the interest attributable to the personal portion as a deduction here. I think my problem really comes into what do I do cents per mile? Which is all we can do. Is that also true in that situation where I'm not really deducting the interest on a Schedule C if I'm doing cents per mile. I'm just taking the cents per mile deduction. Can I still deduct the interest piece on the personal piece? So I'm going to come back to this when we look at the schedule and talk about that a little more. I wrote this before Monday of this week when they issued the instructions to Schedule 1A. So I said, hopefully the instructions to Schedule 1A, which have yet to be issued, but they actually have been now in draft form, will provide clarity. They did not. So I said, if the instructions make it clear you can't use the cents per mile deduction, then obviously our clients would have to go to a paid preparer if they want to take that. Probably not worth it, but that's what you would be faced with. So at this point, we have no guidance on this. It may be that we get subsequent guidance, but at this point, I have yet to find anything that addresses this issue of both personal use and business use. Before I go any farther, has anybody else read or heard anything about that issue? Hearing none, unfortunately, we'll move on. Her comment was just prorate it based on mileage. I think that's a reasonable thing to do, that you would say, we're keeping track of how much is business miles. TaxSlayer in the form even asked us to tell it how much was commuting and how much was total miles. Don't actually have to fill that out to make TaxSlayer work. You only have to do the business miles. But I would agree with you. I think you can use the miles as how do you then allocate between those two. The bill imposes a new reporting requirement on lenders who receive more than $600 in interest on a car loan that qualifies for the new deduction. The lenders are required to file a statement with the IRS with a copy to the borrower showing, among other things, the amount of interest received, when the loan was originated, the year, make, and model, and the VIN. So this is going to be great next year. If you want to see what the form looks like, it's Form 1098 VLI. It's already out in draft form. So you can see what the 2026 form is going to look like. Once again, not going to have that for 2025. So the IRS also issued separate guidance in October for lenders affected by the new reporting requirements. That for 2025, they're not going to have to file that form. But here the IRS said that the lender can satisfy the reporting requirements for 2025 on a specified passenger vehicle loan by making a statement available to the taxpayer on or before January 31, 2026, indicating the total amount of interest received in 2025 on a specified passenger vehicle loan. This can be done via an online account portal, a regular monthly statement, an annual statement, or by other similar means designed to provide accurate information to the individual regarding the total amount of interest on a specified passenger vehicle. So unlike what we saw before, they were mandated. So that's a mandate for 2025, sorry. So if somebody wants to take this deduction, they've got to bring in a piece of paper that shows what the lender told them was the amount of qualifying interest. I personally think without that, you shouldn't take this deduction. So the lender is mandated to provide that to them. They're not in the form of a 1099 VLI, but they've got to provide in some other way, whether it's their online account or an online statement, or they send them something in the mail, but they are required to provide the taxpayer with the computation of the vehicle loan interest and the VIN number. So if they're doing that, that makes our job really easy. So this is one where, while I'm going to talk a little bit about some of the complexity once you get past that, because that is mandated on the lenders for this year, I think we need to ask for that. And without that, you don't claim the deduction, is my point of view. You may feel differently, but that's what I would say. If you receive this information from a taxpayer, I don't think you need to separately assess the qualification. Basically, the lender's telling you, this is specified passenger vehicle loan interest. It qualifies, here's the amount, here's the VIN. Take it and run with it. Don't second guess. So I'm going to tell you some of the other rules in case you decide that you're not going to require that. Again, my perspective is you should require that. But if you don't want to, then you're going to have to run through all these things to make sure that it qualifies. So I'm just going to do this really quickly. Here are all the requirements for the car itself. About got to have at least 2 wheels, can't unicycle, you know, it's got to be a car, minivan, van, sport vehicle, all that kind of stuff. And you can try to figure that one out for yourself about if it's covered by Clean Air. The one that we talked about earlier was final assembly of the new vehicle has to have occurred in the US, which again, I thought was going to be a big problem. It turns out it's not that hard to find out. Plus, if they're doing a report, they're telling you that anyway. So this information, whether it's where its final assembly occurs, actually has to be put on the sticker. So if they've got the window sticker from their new car purchase this year, it's going to have that on it. It's going to tell you where the final assembly occurred. If not, the VIN actually tells you the location of final assembly. Another thing I've learned in this process. Taxpayers are required to include the VIN on their return in order to take advantage of the deduction. So you've got to have the VIN anyway. All the stuff that I've read so far has been consistent that if the VIN starts with any of the following characters, the vehicle was assembled in the US. If the first digit is a 1, 4, 5, 7F through 7Z, or 70, it was assembled in the US. And what I also understand is that the only one they're actually using right now are 1, 4, and 5. So if the VIN starts with a 1, 4, or a 5, it's good. It was assembled in the US. If it starts with anything else, with the possible exception of these 7 and 70 numbers, then it wasn't, the final assembly didn't occur in the US and it doesn't qualify. But again, if the lender's providing you a statement, I think you just rely on the statement, you go with that. You don't have to separately assess this. Yes, sir. Hold on just a second. I'm gonna wait for the microphone.
This is probably obvious, but like some other things, Mexico and Canada are not considered assembly in the US.
That's correct. So that whole issue of final assembly is really complicated because a lot of domestic cars, because of NAFTA, are done in Mexico or Canada and then imported into the US. And vice versa, there are things that are assembled in the US that are not sold in the US, and it gets really complicated. But again, you can rely on the VIN to tell you the answer here. So I checked it, worked on my 2 cars. There's also a website that decodes VINs. So if you're really into this stuff, you can go to this website, put in the VIN, and it'll tell you all kinds of information about the car, including the final assembly place. So I did it with one of my cars, and it showed me plan information was built in Toledo, Ohio, so it's good. So here's the Schedule 1A for the car loan interest. So you see, here's your vehicle identification number. Good luck getting the 17 digits right. But obviously the most important one is the first digit because that's going to tell them where it was built. But you've really got to try to get this right. Now here's the thing that I was talking about before that I think supports that you should be able to do it if you've got both. Why would they have put a column for Schedule C, E, or F and a schedule for A1A unless they thought that, yeah, you can do it for both and it's okay. As long as you've got some personal use, that personal use portion is deductible. So I think that's pretty strong support for my position that I should be able to allocate. Even though the instructions don't talk about that at all. They don't mention that separate line, columns and stuff. But here's our $10,000 limit, and down at the bottom again was the income phase out. Okay, so I'm going to stop, and we're going to talk about, are there any comments or questions on vehicle loan interest? So that one actually turned out easier than I thought it was going to be once I got through it.
There was a question about it starting with a 2. You already answered that. Is the interest only deductible in the year of purchase Or if a person bought the car in 2025, they can take the deduction in 2025 or 2026, et cetera.
Yes, it's going to be deductible for the years 25 to 28. You can deduct that every year,
All right. And I thought
whatever interest you paid in that year.
And I thought you could take the business portion of a car loan on Schedule C, even when you take the mileage deduction. We not there yet?
Okay, so when you do Schedule C, if you do cents per mile, you don't deduct interest.
Right.
It's included in the cents per mile calculation. So that's why I say it gets kind of funny. How do I fill out that form if what it shows, again, I'm not sure I can. Oh, there, yeah. So how do I fill this out if it's a cents per mile calculation? I'd probably just put whatever the interest piece was that was attributable to Schedule C, even though the IRS won't actually see that deduction on the Schedule C. That it?
Someone is, yeah, I think you answered this about a VIN number. They were commenting that they thought it was based on the 11th digit, but you said it's the first, so it's the first.
That's everything I've read has said it's based on the first digit.
Okay, so if you don't agree, go do more research and find out for yourself.
Yeah, you can always use that VIN decoder.
Yes.
That VIN decoder will tell you. So if you don't like my answer, then go try that.
Thank you very much.
Okay, so we could either stop for lunch now, or I can go a little bit longer and then we'll stop. Okay, so we'll go a little bit longer. You got a comment, question?
Hey, I just wanted to correct the record on Schedule C. So the mileage deduction, it's my understanding that is for car maintenance and gas. That is not related to your car loan.
Okay, who?
Yeah. So the way I've been doing it for a long time, and we just looked it up real quick, the car loan deduction is an additional line item on your Schedule C. So it would be a portion between the two, which makes this form make sense.
Correcting that. I'd like to prove that to myself.
Yeah.
I hear what you're saying. So if that's correct, then that gets easy. So you could ignore the whole cents per mile thing. I thought the only things that were really separately deductible with respect to the car were tolls and parking and some of that kind of stuff. But you probably are correct. You all seem to be pretty comfortable with this, that it's separately deductible. It's not included in the cents per mile. Okay. So that would make this much easier. So I apologize if I got that wrong, but no guarantees I've got all this stuff right anyway. So, okay, so let's roll on. State and local taxes. So you guys are all familiar with the 2017 tax reform bill imposed a limit on the amount of state and local taxes that can be taken into account for itemized deduction purposes. The limit was $10,000 for all state and local income taxes, real estate taxes, personal property taxes, and general sales tax. You know, you can deduct either general sales tax or income tax. You can't do both, but all of those are subject to the $10,000 limit. So this was obviously a huge issue in the one big beautiful bill discussion. So where they finally came out was they increased the SALT limit to $40,000, $20,000 on an MFS return for 2025. So we go from $10,000 to $40,000. The amount will be $40,400 for 2026, then increased by 1% a year for the next 4 years. And then in 2030, it actually reverts back to $10,000. So we're going to see it bounce up for a few years, and then it's going to drop back to $10,000 again. And that's all related to how much the bill cost and what they were willing to spend on it. So that's why they limited that. The $40,000, $20,000 limit phases down for taxpayers with income above $500,000. So really high income limits here. So basically everybody's going to get their SALT deduction that we care about in Vita. And even for the people where it phases out, it can only phase down 10,000. 10,000 is the lowest number that you can get to. This change will certainly enable more taxpayers to itemize, but whether they even need to itemize is going to be impacted by other things that have happened here. So like the senior tax deduction is going to make it less likely that people will need to itemize. tip deduction, overtime, all those are going to go into this, whether we need to. So pretty simple here. This is the Schedule A. This language now says, this is the new 2025 form, says enter the smaller 5D or 40,000, 20,000 in married filing separate. So that's where that used to say 10,000. Now it's got the 40, 20 numbers in it. So again, this is all automatically calculated by TaxSlayer, but that's where you'll see that limit kick in. So let's talk a little bit about itemized deductions. So OBBB increases the likelihood of a taxpayer benefiting from itemized deductions because of the increase in the SALT limit, especially for those people with higher income, because they're triggering more state income tax. On the other hand, for those eligible for the senior deduction or one of the other new deductions like the tip deduction, the likelihood that they need to itemize is reduced. So it's kind of going both ways. So I was asked to comment on this about, so how do we think about whether we need to itemize or not? So we're going to go through some tips on all of that. Remember, you always want to start with the North Carolina. Obviously, I think we've got some South Carolina folks in other states on Zoom and stuff. You look at your own state for that. But for North Carolina, the standard deduction is what really drives this decision because, as we talked about already, the standard deduction in North Carolina is much lower than the federal. So if we can get a benefit from North Carolina itemizing, we want to do that if we can. The standard deduction in North Carolina, I give you those again. As we all know, entering itemized deduction is a time-consuming task. So here are just a few thoughts I had on how do we think about this. So the first one is, we've already talked about this, do the rest of the return first and see if it makes a difference. Because if it doesn't, they don't owe any tax, don't bother with itemized deductions. The key lines are on the federal return, it's line 16. If that shows no tax due on line 16, the deduction, the itemizing isn't going to do them a bit of good. On the North Carolina form, it's line 15 of the D400. So if no tax is due on either of these lines, itemizing will do no good for them, so don't bother going through all of this. If tax is owed on the federal North Carolina return, then your only recourse is to figure out whether or not they can itemize. If only federal tax is owed, then you want to use the higher federal tax deduction, standard deduction numbers to make your assessment. Remember, for medical, you got to have a lot of medical for this to work. So you got to meet that 7.5% AGI floor before any medical is deductible. My suggestion is that you do a rough calculation and see if it's close. And if it is, you really have no choice but to put it in TaxSlayer. So again, if they owe tax and you do a rough calculation, medical is the one that gets a little bit complicated. But again, for people who now can take up to 40,000 of state and local tax, that number is going to get a lot bigger than the 10,000 was. So more likely that they're going to be close enough to have to put the numbers in. If tax is only owed on the North Carolina return, remember that the only state taxes deductible for North Carolina purposes are real estate. So the increase in the state tax itemized deduction level really is not going to have any impact on the North Carolina thing. So it really is kind of same as old law for North Carolina. The 40,000, 10,000 limit didn't apply except if your real estate taxes were more than 10,000. We don't see a lot of those clients, so. And again, if you're not familiar with this, if you put the itemized deductions in, if you go to this compare deductions, it'll show the taxpayer, here's the standard deduction amount, here's the itemized deduction amount, so that you can show to them, see, the standard deduction's better. So that's why the program chose to take the standard deduction. Okay. Any questions on state and local tax? Again, that's all done automatically by TaxSlayer once you put the numbers in. But again, I encourage you, don't go through all the hassle of entering the itemized deductions until you've made sure that they actually owe tax. Keep going. I'm not very I'm not sure I want to start 529 because there's actually a bit to talk about on that. Since lunch is here, why don't we go ahead and start the break? So somebody want to, why do you want to tell them about lunch?
Yeah, so at this point, it's going to take us a minute to bring in the sandwiches. And don't forget that these sandwiches are for those who ordered them when you registered. Those are the only amount that we were able to order. They are $15 each, and so please have exact change because we're not cashiers and we don't take cards. And you know, everybody was largely very gracious, but we have no funding. And so that's why everybody's covering their own lunches today, but they'll be bringing it in. And so if you ordered a lunch downstairs, they'll be at tables, I believe is where she's setting it up. Also, I had sent an email to everybody talking about the canteen, which is a tiny little shop downstairs that would largely be empty. So if you wanted drinks to bring your own. So I've had somebody go down and take a look at it and they say, you know what, there are some drinks in there. There's a couple of small salads. You have to use a debit card or a credit card. That doesn't take cash down there, but that is an option for you. And Kara, I'm going to get you or Bill to tell us the exact time for returning, for when you want us to break and return. So 1 hour. Okay, that's 58 minutes. Oh, yeah, that's right. Actually, I have 12:45 hot back in here. And please don't linger rolling back in because Bill's trying to get a lot in here and a lot accomplished. So I appreciate everybody working it hard. Any questions? Come find me.
Well, Kim, let's incentivize people to be back 3 minutes early and they can win something.
Okay, yes, if you get back here 3 minutes early, I told you I was retired. They keep assigning me jobs. So if you guys get back here a few minutes early, we have questions and you can win a prize. There's 3, you said 3? Okay.
Mine's full.
I do all this on my own. I don't have anybody review it because I want to take sole responsibility for the mistakes. So the mistakes are all mine, but I appreciate you guys letting me know when you disagree with something or something. The interest, you are correct, and this is new learning for me, that even though you're doing cents per mile, you can separately deduct the interest. So I did confirm that. I got multiple emails from people telling me that that's true. So that is correct. So forget everything I said about the worrying about the cents per mile. And again, the way they've set up the form with having a column for Schedule C and a column for 1A, I think that takes the issue away. So I'm comfortable that you can put on there, if it's part Uber, part personal, put the Uber part in on the Schedule C line and put the personal part on the 1A line. You wanted to say something? You agree? Great. You got to get a mic if you want to talk, other than say, yeah, I agree. So.
This was the thing I wanted to say. Oh, people don't have this.
So my question is, does that make it out of scope? Since we can't do actual vehicle expenses?
Oh, no. I don't think so. I think.
That's not an actual vehicle expense?
No.
So you can fill mileage rate and the interest.
To me, it's all about, you can either take cents per mile or you can take actual expenses that are covered by the cents per mile, which would include repairs, maintenance, gas, oil, all that stuff. But if it's something that's not on that list, that's perfectly fine.
Okay, that's why I
If
was-
you look
was
at the
asking.
4012, I should have written down the page number.
So there are different.
4012 on car and truck expenses specifically talks about what's in the cents per mile and what's not in the cents per mile.
Exactly. So there are additional things like the registration fee, like the property tax on the vehicle. There are other expenses related to a vehicle that are on a Schedule C that have nothing to do with the mileage.
Wait,
We got rules here.
Got to follow the rules here. But I'll tell you, the part of the reason that surprises me is like lease payments are not. They're rolled into the cents per mile, but interest is. To me, that doesn't make any sense because lease payments are the same thing as acquisition costs of the vehicle. One's included and the other one's not. I don't understand the rationale, but you're right. That's the answer.
Okay,
Yeah.
what I said was, if you're gonna do the property tax and insurance, you gotta be tracking the entire calendar year miles. And I don't think most people do that. You're lucky just to get the business miles.
I agree with that. I think insurance is in the cents per mile. Yeah, so not insurance, but property, vehicle registration taxes. So personal property taxes on cars, that is separately deductible. Okay, second one, VIN number. I have heard from a reliable source that I was wrong on that as well. Although I can tell you, I've looked at least 3 sources before I put that in the thing that all said the first digit is tells you the country of, it says country of origin, but it said that shows you where the final assembly was. I am now pretty convinced that
Was it Bob?
it's actually the 11th digit.
Was Bobby the one that was talking to you?
I'm sorry, Kara, I can't hear you.
Was Bobby Smith the one that was talking
No.
to you about it? Okay, because they were saying, apologies, it is number 1 for tax purposes. So let's just leave that be.
So the comment there is, I'm going to figure that out or try to. So I'm not 100% clear that my slides are right. I'm not 100% clear they're wrong. So let me come back to you. This will be one of our update emails. I'll try to clarify that for you. Yes.
I just want to make sure, is there anybody in this room that is on Zoom? Please say no, because the audio is repeating. That's why I'm asking. Okay, thank you. ChatGPT is wrong half the time.
Okay. When I'm talking, it'd be helpful to turn off the mic. See, that may be why it's doing it. So make sure you turn in, those of you who have mics, and turn them off after you're done talking. Somebody had a comment about ChatGPT. Wait, you got to get a mic. Hold on.
is ChatGPT. So what ChatGPT says, the first number it equals North America. So that could be Mexico or Canada also. The 11th number just gives you the assembly plant code. So I'm assuming then you would have to look up where that assembly plant would
Again,
be.
we're not going to resolve this today. That's the bottom line. I'm going to try to figure this out. Anybody who has an idea to convince me what the right answer is, please feel free to email me. You all have my email address at the end of the handout. So anybody can assist with that, that would be great. So that's all I've heard so far. So now we're going to keep rolling. So we're into section 529 plans. So One Big Beautiful Bill makes several significant changes to the scope of 529 plans. I don't know how many of you see these. We see them with some frequency at our site that have previously been used to cover post-secondary educational expenses as well as tuition for elementary and secondary schools. There are two different effective dates to make this more confusing. Most of the changes apply to 529 distributions that occur after the date of enactment, which was July 4th, 2025. The changes discussed below in the amount of elementary and secondary expenses is 2026. So I'll point that out when we get there. So for 2025, you need to know when the distribution occurred if the expense is one covered by OBBB changes in order to determine if it's a qualified distribution. If it's an expense that's only qualified because the OBB changes, it has to have occurred after July 4th, 2025. So what are those changes? It expands the type of expenses that can be covered for distributions after July 4th. So for elementary and secondary education expenses, prior law only permitted tuition to be a qualified expense. The new bill expands this to include curriculum, books, online educational materials, certain tutoring costs, fees for standardized testing like the AP, SAT, and ACT, and educational therapies for students with disabilities. So for elementary and secondary schools, much broader now. It used to be just tuition. Now it's a pretty broad definition of what's permissible from a 529 plan. Tutoring has to be done by a person who's licensed as a teacher in any state, is taught in an eligible educational institution, or is a subject matter expert in the relevant subject. I'm just telling you the rule. In addition, qualified educational expenses for 529 plans, and this is a big change, are expanded to include what are called qualified post-secondary credentialing expenses. So that includes basically everything. So it includes associate's degrees, bachelor's degrees, graduate degrees, an industry recognized certificate or certification, apprenticeship certification, or a license recognized by a state or federal agency. So much broader. It used to be kind of the typically college expenses. Now it's a much broader definition. So examples would include trade licensing, such as electricians, plumbers, beauticians, nursing assistants, and similar workforce training programs. Also included would be real estate licensing and licensing of attorneys and accountants. So a lot bigger. The types of costs that would be qualified include tuition, fees, books, and supplies relating to training or certification programs, exam fees, and the cost to maintain a license, including continuing education expenses. So again, much broader definition for what's permissible under a 529 plan. The other change is the one that's a 2026 change, and that's that distributions for qualified educational expenses for elementary or secondary school used to be limited to 10,000 and it was just tuition. Now it's broader and it goes up to 20,000, but that's a 26 change. So for this year, it's 10,000, and we've got the post July 4th, pre-July 5th differences in how the expenses are covered. Oops. That make sense? Maybe? All right, so that's it on that. Any questions on 529? Okay, Form 1099-K. Number of pretty significant changes in reporting requirements for 2025. We're going to talk about more later. There's one significant change, which I've already mentioned, which is that it retroactively changes the 1099-K reporting requirements back to where they were prior to the changes made in 2021. So 1099-K is used for all kinds of gig economy stuff, credit card, all that kind of stuff gets covered there. A Form 1099-K will only be issued for 2025 and later if the total amount of transactions exceeds 20,000 and the number of transactions exceed 200. So basically, probably won't see a whole lot of these anymore. But as we've already talked about, that's a real disadvantage for people who want to claim qualified tips who are independent contractors. So hopefully we'll see people like Uber issue the 1099-K even though they're not required so that people can claim the tips. But otherwise, we're probably going to see a big gap there between situations where people can claim the tips and where they can't. Any questions on any of that? So now we're going to move to, so that's what's 2025. So let me make one comment, which is there's a handout that's my attempt to kind of say, here's what's happening in OBBB for 25. Here's what's happening in 26. Here's what's happening in 27. What's happening in 28. Many of you did not get that handout, but that's okay because as we've already said, we're going to send out all those handouts. Claudia's going to send them out tonight or tomorrow sometime in the next 24 hours or so. We're going to send out all the handouts today so that if you didn't get it, don't worry about it. You're going to get this. Yes, Claudia. You got to talk on the mic.
But they had to be registered in order for me to get their email and send them this information.
Yeah.
And so I don't want to get 720 emails tonight, all with different email addresses saying I didn't register. Okay. So heads up.
Okay, so now we're going to turn to, yes, sir. I'm sorry? Oh.
Just a question on the personal question, I guess, on the 1099 K.
Yep.
Why would they make that change and raise that up? Who does that benefit and whatnot? Why increase it?
Do you want my cynical answer or my?
Your cynical answer.
Okay. So, you know, that's an interesting change because the reduction in the 1099K reporting requirement was included in back in 2021, I think it was, because it was a revenue raiser. Because the more information reporting that's done, the more compliance you're going to get. Without the reporting, then there's less compliance. I'll say it that way. This change is basically a response to people complaining about all the credit card companies and Uber and everybody else saying, we don't want to have to issue these forms. So now it's going to cost money because what would have been more compliance now becomes less compliance. So, so it's basically just a response to complaints. You're going to see later, they made some other information return changes that are even more interesting. I'll put it that way. So we'll talk about those. Okay, so there are numerous changes as that one sheet shows you. There are a whole bunch of things more than what's happening this year that are going to kick in future years, including lots of ACA changes that I want to talk about. So this is just a quick summary. Again, this is not the detail. You're going to have to live through that next year if I still feel like doing this next year. So you'll hear all the details next year of what all these are, but for now it's just kind of to alert you that this is what's coming down the pipe. The energy credit that's in scope for VITA is the Energy Efficient Home Improvement Credit. This credit was supposed to last through 2032, but it got repealed effective December 31, 2025. So it's still be in place for 2025, then it's gone. And property placed in service means it has to be operational. So it's actually up and running, it's connected. It's not just because you wrote a check on December 31st to the HVAC company to put in a heat pump for you. It has to be installed, operating by December 31 of 2025 to qualify. We're going to talk about, there are also some changes to this credit for 2025, so we'll talk about those in a bit. Child independent care credit. So here's a positive change. Beginning in 2026, it increases the maximum amount of child independent care expenses that are subject to the credit from 35 to 50%. So more child dependent care expenses will qualify for the credit now. However, that 50% limit, just like the 35% limit now, is subject to phase outs as your income goes up. But the bottom line is 50% only applies if the taxpayer's AGI is less than $15,000. So it's pretty low income that you're going to see the 50%. But for quite a few people, though, you're still going to see, as the income goes up, an improvement in the percentage of expenses that qualify. Student loan forgiveness. So OBBB permanently extends the exclusion from income of student loan debt that was forgiven due to death or disability of the student, but now adds a valid SSN requirement for the taxpayer whose debt was forgiven. The valid SSN requirement is for student loan debt forgiveness beginning in 2026. So that SSN will kick in next year. Importantly, though, OBBB does not extend the broader student loan debt forgiveness provisions that applied for the years 21 to 25. So this relief will expire. So remember, under the Biden administration, they put in a much broader student loan debt forgiveness provision, which North Carolina chose to never follow, but that now is going to terminate. It was a temporary provision that expired at the end of 25. They chose not to extend that. So the only student loan debt that doesn't require forgiveness that doesn't require income is death or disability, or one that was pre-existing the Biden rules that are for like people who work in public health in a rural area for some period of time. They get their debt forgiven. That's pursuant to the terms of the debt agreement. So there are student loans that are set up to encourage people to go teach or to go provide medical care in rural areas, for example. Those student loans, by their terms, provide that they are forgiven over time. That is still excluded from income. But anything else, like all the student loan debt forgiveness programs that Biden put in place, those now will be taxable if it happens. They're probably not going to happen after 2025, but that's the rule. You have a question?
What if you are public service loan forgiveness? Because I've had a few of those, like teachers or people who work in local government or state, federal.
I'm sorry, say that again.
So if you get your loans forgiven via public service loan forgiveness, like a teacher, et cetera, is that, the last I heard, that wasn't taxable federal?
That's correct. It's not taxable federal
So
or
that
state.
still applies.
So that was a pre-existing rule before the Biden administration.
Okay.
That's still good. That's always been good, still good.
Okay.
The
But North Carolina doesn't follow
disability was always good. It's still good. It's the other things that Biden added. Those are all gone and no longer not taxable if they happen after 25.
Okay, thank you.
She asked one other point, and that was about North Carolina. Do you happen to know the taxability for North Carolina?
So North Carolina, I am pretty sure that North Carolina is going to follow the federal rules. Because what North Carolina said was all the new stuff that Biden put in, they didn't conform to those changes. Those are all going to be gone after 25. So starting in 26, we don't have to worry about the conformity issue in North Carolina. Not that many people probably dealt with that issue anyway, but technically anything that was forgiven during the last 4 years under one of Biden's additional programs, not the original programs, but the additional programs that he added where you could have debt forgiven, that was not taxable for federal, but was taxable for North Carolina. Now I think we're back to a complete conformity on this for North Carolina, starting in 26. Anybody disagree with that? Hearing none, we'll move on. Qualified business income deduction. This is one we don't think about a whole lot because it's all done automatically by TaxSlayer. But the bill permanently extended the 20% qualified business income deduction that was adopted in 2017. We normally see that for self-employed people. So anybody who's got a Schedule C would have gotten this QBI deduction, and also REIT dividends, which are in the 1099 DIV. There's box something, I don't remember the box number, but it said 198, section 199A dividends. Those are from a real estate investment trust. Those also generate QBI deductions. That's where we typically see it in Vita programs. So TaxSlayer again is doing all that for us automatically, but now that's been permanently extended. The bill, however, makes several changes to the deduction. First, it increases the income threshold for the deduction, so more taxpayers qualify, but they were already really high, way above what typical Vita client's going to be, so that isn't really going to have much of an impact. But the other one is they provide a new minimum QBI deduction, which will start in 2026. You have a question?
And we might determine if you want to take questions all at the end of the session.
Yeah. Go ahead. Let's see what it is, and I'll tell you if we're going to hold it.
I just wanted a reminder of what is in scope for doing Schedule Cs with Vita. Or maybe you can tell me what's out of scope, whichever one's easier for you to reiterate.
Okay. I mean, in general, for Schedule C for Vita, basically the way I like to talk about it is it's simple, it's sole proprietor, simple business. It's basically non-employee compensation. So it's similar to if you were an employee. but you're a non-employee. So you get to take some expenses like our Uber drivers and stuff. So what kicks in being a problem on Schedule C for us is a loss on the Schedule C, which that's often an issue with Uber drivers because the cents per mile deduction throws them into a loss. That's out of scope for us. The other big thing is kind of all the stuff that you associate with a bigger business. So things like you got employees, you have benefits, you have cost of goods sold, you keep inventory, all that kind of stuff would throw you into being out of scope. So again, it's really kind of service business that we can do along with expenses associated with that. So, our typical advertising, office supplies, mileage, those are all good. But once you start getting more complicated, it gets kicked out. So again, the front of the 4012, if you go to the early part of it, that's the scope of service thing. There's a whole section on Schedule C and what's in scope and out of scope for that. Okay, so we're going to have this new, beginning in 2026, we're going to have a new minimum deduction of $400. But the taxpayer has to have had QBI income of at least $1,000 to be able to get the minimum. And the way the calculation works, once you get to 2,000, you'd already be at 400 anyway. So basically, it's just going to help people who are between $1,000 and $2,000 of qualified business income. So if you get a Schedule C that's somewhere between 1,000 and 2,000, it's going to make it 400. Otherwise, it doesn't really mean a whole lot. Yes, ma'am.
The other big benefit is for people who only have self-employment income, because the QBI is 20% of the net profit or taxable income. So if they had no taxable income or very little taxable income, you could get a benefit even with less.
That's a great point. Excellent point. So yeah, people with no taxable income, this also could benefit them as well. Thank you. Home mortgage interest. So I've already mentioned that OBBB permanently extends the $750,000 cap on mortgage interest. It also continues to not allow a deduction for home equity loan interest, but it, beginning in 26, adds back PMI. So any primary mortgage insurance will, starting in 26, become deductible interest again. But again, that's next year, but we'll start seeing that. So on the form, the 1098, whatever it is that I'm not thinking of right now, that form typically has a PMI box on it. So that will it'll be treated as interest for next year for itemized deduction purposes. Charitable contributions. This is another big change, and I think this is another one where there's going to be some confusion because people will have heard some things and find out that it wasn't applied to 25, it applies starting 26. So there are two big changes to charitable contribution deductions, and this is a permanent change in the law for years beginning after 2025. So first, it brings back the charitable contribution deduction for non-itemizers that we had in 2020 and 2021, but pops the number up to $1,000 on most returns and $2,000 on a joint return. But remember that the limitations are the same as they were before. It has to be a cash contribution. It can't be property in-kind contributions. And it only applies starting in 2026. So we'll meet this again next year with people needing to provide us with information about their cash charitable contributions. They're now going to be able to take up to $1,000 or $2,000 on a joint return. Second is it introduces a new limitation on charitable contribution deductions by itemizers. So these were basically trade-offs to pay for each other. So beginning in 2026, the deduction for charitable contributions on Schedule A, basically it's going to create a 0.5% floor for charitable contributions, 0.5% of your AGI, basically. So only contributions in excess of 0.5% of the taxpayer's income will be deductible as an itemized deduction. So it's going to create, for those people who are itemizing, something similar to what we see for medical, but obviously at a much lower rate. Medical's at 7.5%, this is 0.5%. But so that'll kick in next year as well. And remember, obviously, you only get one of those. You're either going to take the charitable contribution deduction for a non-itemizer, or you're going to take the new limited itemized deduction contribution. Gambling losses, another surprising change. So first, it makes a significant change to the current law beginning in 26 that only permits a deduction for gambling losses up to the amount of gambling winnings, which includes all your gambling related expenses for professional gamblers. So their travel and all that stuff all is subject to that same limitation. But then what was a bit of a surprise, they decided to limit the amount of gambling losses to 90% of the amount of gambling winnings. So not only is it going to be can't take more than your gambling winnings, now you can't take more than 90% of your gambling winnings. So for a taxpayer, if they bet $10,000 on sports betting and they win $10,000, so basically they broke even, they're now going to be taxed on $1,000 even though they broke even for the year. You know, this isn't a big thing for casual bettors, but for professional bettors, professional gamblers, this is a big issue. They're not happy about this. So we'll see. I think there's a chance this one's going to go away. There's so much grief from the people in Nevada in particular about this one that this one may change before it ever gets in place. But again, that's a next year issue. Got a few comments, questions here?
Yeah. It's my understanding North Carolina does not allow the gambling deduction on itemized.
That is correct.
I'm sorry, I'm just a little bit confused. So we're close to the Cherokee Casino, so we have lots of people who bring in all these
You're going to see
things.
this next year.
Yeah,
Yep.
we see lots of this already. So in your example, they bet $10,000 and they won $10,000, so they didn't lose anything. I'm a little
Correct.
bit confused.
Yeah. So again, these are cumulative. Let's say they did multiple.
But if they had,
they gambled, you know, went for several weekends during the year. They bet a total of $10,000 and they hit one time and won $10,000. So we would say gambling losses should offset the gambling income. You don't pay any tax there. What the new law is going to say is you can only deduct up to 90% of the gambling winnings. So 10% of your gambling winnings are always going to get taxed. That's basically the bottom line. Is that
okay, I'm with
no
you
matter
now.
what happens, you're always going to
Yeah.
pay tax on at least 10% of your gambling winnings.
Yeah, thank you. That helps me understand. Thank you.
Miscellaneous itemized deductions. So in addition to permanently extending the repeal of virtually all miscellaneous itemized deductions, it's going to allow a new miscellaneous itemized deduction for educator expenses. This one's really confusing about how it's going to work, but again, we'll find out next year. I think it's got to be the amount above the $300 adjustment because it refers specifically back to this $300 adjustment. So it's the same people who get the $300 can now get an additional miscellaneous itemized deduction for the same expenses. There aren't a lot of teachers who are probably itemizing, but you know, for those who do, it looks like this will be an additional itemized deduction for them. And it's also got extended to coaches and interscholastic sports administrators, whatever those people are. So again, more to come on that because I'm not sure. I think they've got to say it's in excess of the 300, but that's not clear yet. Again, it's effective for 26. Bill also makes permanent the limitations on moving expense deductions, which applies to JD, but he's about the only one here because that you have to be active duty military. But it also now extends it to moving expenses of members of the intelligence community. So if you work for the CIA and you get transferred to London, you get to deduct your moving expenses now. The prior limitations on casualty losses to federally declared disasters and the 10% AGI floor are made permanent. They added state declared disasters. So if there's a disaster that's declared for state purposes, but not federal, that's going to be good enough now. And this also doesn't impact all the special rules. Like for Helene was a great example of one where Congress passed special rules that allow casualty loss deductions way better than what this allows. Those rules are unaffected by this. This is just dealing with the other disasters. Again, all that's out of scope for us. So just something to know. Beginning in 26, the bill adds a new overall limit. So those of you who've been doing this for a while, remember back in the old days, we had a limitation on your total itemized deductions. It operated differently than this is going to operate. They're bringing that back in a new form, which basically says for people who are above the 37% tax bracket, their their itemized deductions are going to get limited to the 37% rate. So they don't get a deduction based on whatever their 39% rate. Their charitable they keep saying charitable, itemized deductions will be limited to 37%. Obviously, this is for people with really high income. Again, not really an issue for VITA. Or if you're doing returns for that in VITA, I question what you're trying to do here. So, okay, so this is coming back to something we talked about, or I hinted about earlier. So other information reporting changes. This was really surprising. So beginning in 26, the income threshold to require the filing of certain information returns will be increased from $600 to $2,000, and that $2,000 will be subject to inflation adjustment. That's going to apply to W-2s, 1099 NEC, and 1099 miscellaneous, other than for royalties reported in a MISC, which we continue to use a $10 threshold. So we're going to see a big jump in NECs. So when we got people who are getting NECs that are getting qualified tips, that's going to jump to 2,000 next year from 600. This doesn't impact other 1099 forms like INTs and DIVs. They have their own rules for thresholds. This is one when you try to describe why did they do this that I struggle a bit with, other than to say people complaining about it's a lot of work to issue all these 1099s. But beyond that, this is kind of encouraging non-compliance, so it's a bit of a mystery. But W-2s. I'm sorry?
Okay, gotta wait. We can't just have.
Okay, so her question was, if they don't issue a 1099, a W-2, how are we going to know what the state income tax withholding was? Great question, to which I do not have an answer. So if you don't get a W-2, I guess final pay stub would show it again. So we're going to have to resort back to other sources of information for the withholding. What's interesting is I'm not sure they're necessarily changing the federal withholding rules. So you probably could end up with people who have federal tax withheld, but yet they don't get a W-2. So I think you're going to have the same issue on the federal side. So a bit of a mystery, but that's what the change is.
Hang on, who's got a question?
Do I have questions?
Trying to understand.
Okay. So today, if you make less than $600, they won't issue a W-2 or a 1099 NEC. Next year, that's going to jump $2,000. So if I earn $1,900 today, I'd get a W-2. I'd have to report that income. Next year, I'm not going to get a W-2. I still should report that income, but now I don't have information reporting. Exactly right. And that's the point she was raising is, and so this will be interesting to see when they actually start publishing the guidance on all this stuff. Do they say that, well, but if you've withheld federal taxes, you still have to issue the W-2? I don't know the answer to that. It's possible they do something like that. So they would say, if there's tax withheld, you still have to issue the W-2. That's a separate issue from just the initial threshold question. So,
Not a lot of money.
yep.
And
Yep.
They still got
Yeah.
stuff they want back.
So again, this will be a next year training discussion.
Oh,
Yes.
okay, and I was looking at the burden that that's going to put on the tax filer and on us. And then on the companies, when the people keep going back, I need my W-2. So I think one of the things as site coordinators or whatever that you can start putting in your advertisements, just ask them to start bringing in, make it happen, start this year, hold on to your last check stub.
Pay stub. Yep.
Your last pay stub, hold on to that and have them bring those in, and that will give you the information. And it's from whatever job. If they were at this job from February through March, hold on to your final pay stub. And that's going to help you in the long run. So just start advertising, especially if you have repeat clients. You can start sending out helpful messages throughout the year, and that can probably save you a lot of burden during the tax season.
Yep. Excellent suggestion. Any other comments, questions? Okay. I'm sorry?
Having multiple jobs throughout the year,
Yeah.
especially like students.
Yep.
What they're talking about is multiple jobs throughout the year for those who can't hear it. So I might shut down the comments a little bit because it's kind of hurting the chat
Okay.
with those folks who are not able to hear the constant comments, rather than let's keep it to when you say, let's take questions.
Okay. So again, the point is, yeah, we're going to have lots of situations where it appears people are not going to have W-2s or 1099 NECs, but they're making close to $2,000. How are we going to catch all the withholding and all that? We'll figure that one out before next year. Education credits. So beginning in 2026, in order to claim either the AOC or the lifetime learning credit, the student, and if the student is not the taxpayer or the taxpayer's spouse, the taxpayer claiming the credit has to have valid SSNs. So this valid SSN thing, here's another one that's going to kick in next year for the AOC or lifetime learning credit. And it applies to both to the student, and if somebody else is claiming the student and claiming the credit, that person as well has to have a valid SSN. Trump accounts. So these are, I probably have more on the slides here than the need, but that's because they just came out with a new form. So I think I need to talk about these a little bit more. I think this is going to be a lot of stuff for not a lot of, we're not going to see a whole lot of this stuff. I'll say it that way. So the one big beautiful bill added a new form of tax favored savings programs for children under the age of 18 as of December 31, 2026. So you had to be under 18 as of December 31, 2026, and you have to have a valid SSN. This new account is going to be a custodial IRA, not a Roth. So it's going to be a normal IRA. Contributions can be made to the account. I'm giving you obviously a summary here of all the rules. We're going to have lots to talk about next year on this, but contributions can be made to the account during what's called the growth period, which is the period from creation of the account until the end of the year prior to the year they attain age 18. During that period, contributions can be made by parents and other individuals as well as employers up to $5,000 a year into these accounts. Beginning of the year the child turns 18, the normal IRA rules on contributions and distributions apply. So it's kind of a two-headed beast where it's like there's one set of rules for when it's created until they hit 18, and then it flips into being a normal IRA at that point. Okay? I'm going to talk some more. So I know it's confusing right now. Give me a minute. And in addition to this, children who are born during the years 2025 through 2028 are U.S. citizens and have a valid SSN, which if you're a U.S. citizen, you should have a valid SSN. The Treasury Department is going to make a $1,000 contribution to the account, and they call that a pilot program contribution. So in addition to basically setting up this IRA, the Treasury Department is actually going to put $1,000 in for every kid that's born from 2025 through 2028. So it's like the whole idea here was you're kind of creating the beginning of a savings account for them. But again, because it's an IRA, it's really not a real effective savings account. But hold on, let me finish going through this Trump account stuff, and then we'll come back to questions. Distributions are very limited during the growth period, and then will then be subject to the normal IRA distribution rules. So not only are they going to be subject to income tax, but unless you have an exception to the 10% additional tax, that's going to apply. So, if they use it for, obviously, age 59 and a half, they've used it for higher education or first-time home purchases, that's fine, but otherwise they're going to pay not only income tax, but they're going to pay the 10% additional tax as well, because it's going to be an IRA at that point. Any contributions by the parents or other individuals are after tax, which to me makes that distribution out of scope for VITA if the contributions have been made, because we can't deal with non-deductible IRAs. And so when a parent or other individuals make contributions to the account, those are non-deductible. That basically makes it a non-deductible IRA. So you have to file the form number that I'm blanking on right now, 5396 or something like that. But that form is out of scope for VITA. I don't think it is for AARP, but it is for us. But that's obviously way down the road before we get to that. I think that's all. Oh, These accounts can't be created prior to 2026. So we'll discuss the details later. So this is just to give you a heads up that people have probably read a lot about Trump, or read some about Trump accounts and this $1,000 that the Treasury is going to put in for all newborns and all that kind of stuff. That kind of gives you a sense of what it is. It's kind of captured within an IRA, which makes it really complicated and all that stuff. And so that's the overview of what it's going to look like, but we'll get into more detail next year on these. But I have one more part to tell you about, but I'll go ahead and see if we have a question. I do have a question down here, sorry.
Who's got my question?
Way down here in the front. Sorry, I got another mic up here, I think. Right, you got one?
Does this $1,000 go to the children of legal or illegal immigrants?
They have to be a U.S. citizen with a valid SSN.
Well, if they're born here, the Constitution says they're a
Current
citizen,
law,
and you can issue them SSN and a passport even. Does that mean they can set up the account?
Are they a U.S. citizen and do they have a valid SSN? If they do, then they qualify.
That's very interesting.
That is not where the president wants to go, but that's
Unintended consequences.
that's the current law. So, okay, the reason I talked about this a little bit more is because the IRS actually just issued a new form 4547. Can anybody figure out where the 4547 came from? I actually missed that. Somebody pointed it out to me. It's like, you know where that came from? I was like, oh yeah. But so this is the Trump account election. This form is used by an authorized individual to elect to create an account for a child who qualifies to have a Trump account. The form may also be used to elect to receive the $1,000 pilot program contribution from the Treasury for children born after 2024 who are qualified to receive that contribution. The form may be filed with the 2025 tax return. But last I checked, it wasn't in TaxSlayer yet. So I don't know if TaxSlayer is going to add this or not. But this kind of introduces an issue, but it's really, to me, kind of an issue we shouldn't really have to deal with, mainly because in July next year, when this kicks in, they're supposed to be creating a new online system that people can sign up at that point to open the account and get the $1,000 and all that. So this is just a precursor to that if you want to file something with the 25 tax return, you can, to basically say, yeah, I've got a child, I can set this up for. Again, just to make real clear, it's one thing about setting up the Trump account, that's for anybody who's under 18 by the end of 26. The $1,000 only is for newborns in 25. But if you have either one of those, you could go ahead and set up the account. I don't see any reason to set up the account if you're not getting $1,000 at this point, because it can't really open till next year anyway. But so I just want to make you aware of that this is an issue. Again, I don't know if TaxSlayer is going to add this form or not, or if you're going to have anybody ask you about adding that. I imagine most taxpayers are going to have no idea that this even exists. So I don't think it's an issue, but I just don't want you to be surprised if somebody says, hey, I need to file form 4547. Just a second.
I know that this will probably be more of a question for next year, and because it would be for an infant, would the parents have to declare that as income?
No, it's not income. So the question, yeah, so no, that's not income to anybody. It's not income to the child, it's not income to the parents, anybody. So. Right behind you, the microphone.
I may have missed this, but on the contribution, the $1,000 contribution, pilot and child has to be born 2025.
Yep.
Is there an income limit for the parents?
Nope.
It's not.
Every child born in 2025 is entitled to that $1,000 contribution. Got another question back there. Sorry. This shouldn't be generating that many questions because it's really
So
not a big
just real-
issue for this year, but
You said that that the normal IRA rules will apply over 18. Does that mean a 16-year-old can't make Roth IRA contributions, or they still apply in addition?
I have no idea.
Okay.
So we'll find out because there's basically zero guidance on this at this point. So how they're going to treat that growth period are they going to treat it as an IRA that impacts Roth and all that stuff? I have no idea at this point.
If I understand this correctly, does a parent have to set up this form in
Yes.
order to get this $1,000 that he's going to send us?
Supposedly, although I'm a bit confused by that, I will tell you honestly, because I've seen other things to suggest that if the parents don't set up, the treasurer will actually do it for them. So I'm not 100% sure on that one yet. This form is clearly for the parent or whoever the authorized individual is
The child won't
to
get it.
establish the account and to request the $1,000. But again, I've seen other language suggesting that Treasury will go out and figure this out too.
That's what I'm trying to understand, because I think a lot of our clients are just not even thinking about this stuff. And they're going to, oh, by the way, my child's entitled to
Yeah.
$1,000. I'm looking forward to it.
But
They
again,
don't know
the
they have to
important
set
thing
it up.
is it's not important that you do this on the 25 tax return. There's plenty of time to request that. It's not even going to, you can't even open these accounts until July of next year. And then they're supposed to open an online portal to be able to do all of this stuff. Our clients, a lot of them won't do online portal, but we can deal with it next year once we know more about this stuff. Anybody else?
So whose social security number is associated with these accounts, the child or the parent?
I would assume it's the child because it's an IRA in the child's name. So I got to think that they're going to put it under the child's SSN, but that's just an educated guess. So if you have a return with a child born during 2025, taxpayer may want to go ahead and do this form. So here's one where I decided it's not worth going into the detail. Who's an authorized individual is different for the two different things for setting up the account and getting the $1,000. There are all kinds of rules there about who's the authorized individual. I just don't think it's worth going into that level of detail at this point. So I just say, if you want to file a 4547 and it's anything other than the parents that want to set up the account, and you get into questions about what if they're separated and all that kind of stuff. But unless it's the parents setting it up, I would say you need to go read those instructions before you fill out the 4547. Okay? That's all I want to talk about on Trump accounts. This is another new thing that you may have heard some about, which is this scholarship funding, getting a credit for making contributions to a scholarship funding organization. So beginning in 2027, so this is even farther out, OPBB creates a new non-refundable credit for contributions to scholarship granting organizations. This is really going to be complex, and we're not going to worry about it because it's 2 years away. So I just want to make you aware of that. If somebody says, well, I heard there's this new credit, this is kind of going off of what some of the states do, like Georgia has something similar to this, where you can make a contribution to a scholarship granting organization. It's to basically encourage private school stuff. So you can make a grant to a scholarship granting organization, because this can be for, I'm pretty sure, for both elementary, secondary, and post-secondary school. But it's going to have lots of rules, and I'm not going to worry about those until 2027. State gift tax, I just throw this out because, again, people may have heard this. The state gift limit for before you have taxable gifts or taxable estate, 13.99 million in 2025. Under the bill, that's going to jump to 15. And if they had not extended it, it would have gone back to 7.14 million. So they've not only kept it at a higher level, they've increased it even more. All right, valid SSN. So I've been talking about this all day, all the new rules around valid SSN. I wanted to go through a little bit of detail on valid SSN. Again, this is my best attempt to explain this. If anybody here knows more than I know, please join into the discussion. So the bill has significantly expanded the tax benefits that require the taxpayer or another person to have a valid SSN. So this is my attempt to explain it. So here are kind of the three primary kinds of Social Security cards, to my understanding. So this first one has no legend on it. Those are Social Security cards that are issued to US citizens and lawful permanent residents. That's a valid SSN. That's our typical Social Security card. The next one is one that has the legend on it about valid for work only with DHS authorization. So a card with a legend that states that it's valid for work with DHS authorization, that's normally issued to non-citizens who are temporarily in the US who are authorized to work. For example, individuals on certain visas who have Department of Homeland Security approval to work, that is also a valid SSN. So if it says it's valid for work, only with DHS authorization, that's good enough for our purposes. The last one is the one that's not. So it says not valid for employment on it. So it specifically states on there it's not valid for employment. Those are typically issued to non-citizens who are lawfully present in the US, but are not authorized to work. That is not a valid SSN for our purposes. Okay? I-10, which I'm sure a lot of you are familiar with, that's an individual taxpayer identification number. That's a 9-digit number that sounds like a Social Security number, but it's not issued by SSA, it's issued by the IRS. And it's issued to people who don't have Social Security cards. So it basically allows somebody who doesn't have a Social Security card to file a return and do certain other things. It's obviously not in the form of a card. Instead, the I-10 is in a letter that they get from the IRS that'll just state what their I-10 is. These always start with the number 9, it's my understanding. And these are not valid SSNs. So again, the two that get kicked out are I-10s and an SSN, Social Security card that says it's not valid for employment. Those are the two that do not qualify for it as valid SSNs. Any comments, questions on that before I'm going to show now what tax benefits this is connected to? Nope. Okay. So what are the tax benefits that are impacted by this now? Earned income credit. This is the same as pre-OBBB law, so this was not changed by OBBB. For the earned income credit, both the taxpayer and the qualifying child have to have valid SSNs by the due date of the return, including extensions. For married taxpayers, both spouses have to have valid SSNs on a joint return. Married taxpayers who don't file a joint return qualify only if they meet an exception. So this actually pops up in TaxSlayer. If you create an MFS return, it'll ask you this question about whether you satisfy these requirements to be able to claim the EIC. So those are the ones that are required. This is an interesting one because unlike all the other situations we see when we talk about marriage, normally to be separated, for that to be treated as that you're single now, requires you to go to court. This is the one exception to that, where a voluntary separation agreement is sufficient. If there's no qualifying child that has a valid SSN, the taxpayer may still be able to claim the EIC under the rules for taxpayers without a qualifying child. So it's basically treated as if they don't have kids. So then you test it under the normal rules for people without kids, whether they can get an EIC. That takes really low income to be able to do that, but that's possible. Child tax credit. So this one was changed by OBBB. So beginning in 25, the taxpayer and the child must both have a valid SSN. In the case of a joint return, only one of the spouses is required to have a valid SSN. So that's different than EIC. EIC requires both spouses. This only requires one of the spouses. And pre-OBBB, only the child had to have the valid SSN. So the parents could have I-10s and that was fine. Now it requires both at least one spouse and the child to have valid SSNs. The senior tax deduction, as we've already seen, now kicks in the valid SSN requirement. The TIPS deduction has the valid SSN requirement. The overtime deduction has valid SSN. Education credits starting in 2026, will now require valid SSN for both AOC and lifetime learning. And it has to be both the taxpayer and the student of the students, not the taxpayer and taxpayer spouse. Student loan forgiveness exclusion. So the new rules in the OBB for forgiveness of a student loan due to the student's death or disability will require the taxpayer to have a valid SSN beginning in 2026. Trump accounts, the kid has to have a valid SSN before an election to create the account can be made. They also have to have a valid SSN to get the $1,000. Okay. Yes, sir. All right, well, Eldon, gotta wait for a microphone. Nope, you can't shout. People won't accept that. Oh, here comes one to you.
Okay, thank you. Will taxpayer have a question asking if they have a valid SSN? TaxSlayer?
No, because TaxSlayer knows that. Because when you put in the SSN, it knows if it's valid.
Okay.
Because if it's not for employment, I'm almost positive about this. Anybody tell me if I'm wrong. I think it also starts with a 9 like I-10 does. So TaxSlayer will know that if it's a 9, it's not valid. But anyway, you can tell that by the Social Security number will alert TaxSlayer. So it doesn't separately ask that question. Good question. Anybody else? Okay, what time? We're going to keep rolling here. So we're going to blow through the ACA changes. What slide am I on? Yeah. There are significant changes to the Affordable Care Act, including to the premium tax credit. These changes are way beyond the scope of this presentation and my expertise because they're very comprehensive. Again, Beyond the Basics has great stuff about this. And the summary that you're going to see in a minute is pretty much, not exactly word for word, but pretty much word for word from Beyond the Basics. But one of the things that's most significant that you are still reading about in the paper to this day, there's supposed to be a vote today on it, is the enhanced subsidies that came in 2021 for the Affordable Care Act. Under those, basically anybody below 150% didn't have to pay any premiums. And people with taxpayers with income above 400% of the federal poverty line were still entitled to receive a subsidy. Prior to that, they weren't. But now they can get a subsidy for costs if it's in excess of 8.5% of their income. All those enhanced subsidies are scheduled to expire at the end of this year. And that's what Congress is, one of the many things it's fighting about right now. This was a major discussion during the shutdown. Congress hasn't yet acted to address the loss. As I said, I think they're supposed to have votes on it in the Senate today, but it's unlikely to pass. This makes ACA insurance more expensive for 2026 and will likely result in a reduction in the number of taxpayers with ACA insurance going forward. Mike, can you comment a little bit about what you're seeing in your practice? This is Mike McDonald from Pisgah Legal Services. They do ACA counseling in addition to their navigator, it's called. So they deal with this a lot. Thought it'd be helpful to have his perspective.
Sure. Hey, everybody. The Senate voted and both of the bills failed to advance. So
okay.
Go figure. We're seeing what you would expect to see, which is a real dramatic increase in premium costs kind of across the board. Something like a third of everybody we've spoken to saw premium increases more than 50% over last year. And somewhere close to 20% of the appointments we've had, of those who did not enroll, about 20% reported cost as the reason that they could not enroll. So, the trends are where we thought they would be. It's a disaster. That's what it is.
Yeah. Okay. Thank you for that perspective. That's kind of where I guessed things were going, but it's good to hear the real world. Oh, we've got one down here. Sorry.
Yeah, I want to point out it's the premium tax credit that they can receive. That is the primary thing that is being out of cost to the people signing up. The premiums, yes, are going up, but it's the premium tax credit that's greatly reduced.
That's correct, because the way the subsidy is paid in the Affordable Care Act is through the premium tax credit mechanism. You're exactly right. So that's what you're going to see is significantly smaller premium tax credits, and thus the cost to the insured goes way up. So again, there are lots of other changes. There are two things that really drove these changes. One are the, I forget the agency that does this now. What's the name of the agency, Mike? I'm sorry? Oh, that's CMA. That's right. Okay. Issues the regulations on this. So they issued a final regulation that substantially changes a bunch of the rules about ACA. But then the One Big Beautiful Bill also has some additional changes to it. Again, go to this website. It's a fabulous website. It'll tell you all about kind of the current status of things. So as things continue to evolve, check that website. So the first thing I want to talk about are the ones that are in the One Big Beautiful Bill, because these are the tax-specific changes. So these are the ones that are going to impact our clients. So this is the big one, effective January 1, 2026. So this is a next year problem, but it's a this year reality, is the repayment limits that apply to protect enrollees with low and moderate incomes from owing large amounts of the advanced premium tax credits back if their estimated income or their household size changes during the year. Those are going to go away. So this provision takes effect for APTCs received in 2026, but it won't be felt by enrollees until they reconcile their APTCs on their 2026 tax return in early 2027. So this is a next year problem, but it's something we need to be talking about today. With the repeal of the repayment limits, as I say, it's next year tax issue, but I think it's incumbent on all of us. Anybody who's got ACA, you got to be telling them they've got to get their income right and they've got to get their family size right. So the first thing I would say is, as soon as you're done with the tax return, tell them to take that tax return, go back and call the ACA and tell them, here's the number on my 2025 tax return. Because that's probably different than what they told them when they signed up. I mean, they will have already been through a month or two or three of premiums under the old number, but try to get that right. But then the other big thing is, if your family size changes during the year, you got a kid that's born or something, or your income changes during the year, you got to call the ACA and tell them this. Because otherwise, I mean, we see this all the time, and it almost always goes the wrong direction, which is people always underestimate their income. Then when we do the reconciliation, they owe back a bunch of subsidy. Today, they're protected by the repayment limits. Those are going to disappear. So, I mean, we've seen people who owed like $15,000 back, but they got protected by the repayment limit. They won't get that next year. So these are people who made like $40,000 or $30,000. I mean, they're obviously not going to be in a position to repay what could potentially be massive amounts of money. So this is one, again, where this is not necessarily a 2025 tax issue, but we just have to be providing this advice to our clients, because otherwise next year is going to be really ugly for them. Any comments, questions on that? Yes, Catherine.
Well, it's more than that. The person who does it right all year long, but then in November or December, they get a job that pays a lot more. That changed everything, and it is factored into the income for the entire year. So what do we tell people? Don't take that good job. See if you can wait till January to start. But that is a big problem for a lot of people, and it was one that I saw a lot when we had an active cycle.
I'll give you two others that we've seen before, which are really harmful. One is Social Security disability. So they've been fighting Social Security for years. They finally win their case. They get retroactive Social Security that all hits this year. They got to repay lots, if not all, of their subsidy that they receive. The other one that we see a lot is people take distributions from IRAs. don't think about, oh no, that's going to mess up my ACA calculation, but it does. And so again, you're exactly right. It's way broader than just what you get paid in wages. It's kind of a warning of any kind of income, whether it's from an IRA, it's Social Security, it's not inheritance. That one doesn't count. That's not income. So that one's okay. But anything like that, anything that's going to be income on the tax return next year, they get that, they need to immediately call. But you're right. If it happens late in the year, there's nothing they're going to be able to do about it. Tell them don't go spend that money if that's the situation, because they're going to have to pay back a bunch of subsidies. Any other comments on that? But please, please try to take this one to heart. Yeah.
The one thing they can do is make IRA contributions. If you find somebody who has having to pay a lot of their subsidies back, if they can afford to put money in IRA, that will reduce the amount that they have to repay.
Yep.
It'd be particularly important for 2026 when if you have someone who goes over that 400% and automatically has to repay everything.
Yep.
If you can if they're just barely over, if you can get them under that 400% poverty line, then you can really save them some money. So just make
You
sure
have
you're
to,
aware.
obviously you got to be pretty close to the limit, but if you see somebody, when you fill out, well, the only problem is the 400% taxpayer doesn't compute that for you, but the 100%, 200%, 300%, it'll calculate it for you if they're close. It'll show you what the percentage is. So if you're close, and if they can make an IRA contribution, encourage them to do that, because that will click them below that threshold so that the amount they have to repay will go down. But you're right, 400% is the big one. I mean, anything will help, but it's the 400% is the one that's really ugly.
And I wanted to expand on that.
Yep.
One thing that's in the OBBB is that every bronze level plan now qualifies for HSA.
Yep.
And if they can fund that, they can also bring down their income quite a bit.
That's a great point.
2026, the limit is 4,400. If you're over 55, you can contribute an additional 1,000.
Yep.
To max out at 5,400, which will bring down your MAGI.
Yep. Yep.
So
great suggestion.
Which parts do you want me to repeat? The whole thing?
Basically, what the law did was it said that bronze plans for ACA are now treated as high deductible plans for HSA purposes, so that you can, if you have a bronze ACA plan, which most clients don't, they have other ones because they can't afford the deductibles and everything. But if they have a bronze plan, which has higher deductible, I think it's at 70% of cost or something, I think is the target for bronze, they can set up an HSA. So what he's saying is if you make contributions to the HSA, that'll also drive your income down. So it's another way to drive down income to try to avoid the significance of the repayment. Again, that's really important at the 400% level. That's the one that's really going to bite. So, yep.
No, they don't. Yeah.
I was just asking if those HSA contributions had to be done before year end, kind of like, so if they can do it up until April when we're filing and realize they owe money.
So it's like an IRA in that you got till April 15th to make the contribution to an HSA or to an IRA to reduce your income. So that will be a tool in our toolbox for next year that maybe I'll even remember to talk about it next year. Again, especially for people who are right near the 400% limit, that'll be a great way to get them back below that so that they don't have to repay every penny of, well, no, they're going to have to repay every penny anyway. What am I saying? They're going to have to repay it anyway. So I keep getting confused between the current rules and the new rule. So basically it helps to lower the income to reduce the payback, but it's not going to eliminate the payback. They're still going to get hit. Okay, another 2026 change is that the provision that allows lawfully present immigrants who are ineligible for Medicaid due to their immigration status and whose income is less than 100% of the FPL to access PTCs. You may remember, this isn't one that we see, but maybe some of your sites do. There are two exceptions to the 100% rule. One is this, and the other one is basically you told the ACA that you had income below 100%, and it turns out you didn't, but I'm sorry. Yes, that's basically it. It says you did everything you should have done, and you still got ACA insurance, and turns out your income's less than 100, you can still get premium tax credit. But this one that deals with people who are ineligible for Medicaid, if based on their immigration status, that's going away next year. Eliminates premium tax credit eligibility for people who enroll via an income-based special enrollment period. These special enrollment periods all ended up getting wiped out by the final regulations anyway, so it's really kind of a redundant provision. January 1, 2027, it eliminates premium tax credit eligibility for most lawfully present immigrants, including all these folks. So basically only US citizens, legal permanent residents, so people, green card holders, and certain Cuban and Haitian entrants and people from COFA nations will be eligible. Everybody else is going to lose their premium tax credits. So that will also be pretty dramatic. Effective 1/1/28, it eliminates the provisional APTC eligibility until the marketplaces verify their income and other eligibility criteria. So you're going to see this in the regulations too. They're really into, this is going towards what they perceive as a lot of fraud in the marketplace today. So they are going to make you verify your income and eligibility before they're going to start giving you the subsidy. So, as I say, the effect of preventing people from getting APTC until their information is verified. It allows the secretary to waive this if it's due to a change in family size, like a baby is born. They have the authority, no, not required, to continue to give them APTC while the household's in the process of verifying their eligibility. They're also going to require all enrollees with PTCs to take action to continue their coverage from one year to the next. Eliminating automatic re-enrollment allows marketplaces to use third-party sources to generate information to be verified by the applicant. This is something we see at our site, that people think they've canceled and it's all gone and don't know they even have it, and turns out they have it and they get this 1095A and they don't know what's going on. Supposedly that's all going to stop in 2028. So there'll be no more automatic re-enrollment. People have to reapply for ACA. They have to verify their income and eligibility before they start getting premium tax credit starting in 28. So then there's also a host of regulatory changes, although some of them got halted by a federal court. So these are the ones that were enacted, but basically the court has stopped temporarily, so they can't be enforced yet, but may or may not come back depending on how the federal court ends up eventually handling the issue. So these would have taken effective August 5th, 25th, 2025, would have required new paperwork requirements. People in all states that have been required to submit documentation to get or keep their marketplace coverage. Also allowing insurance companies to add past due premiums to enrollees' binder payments. So basically, if somebody has past due premiums before they can sign up the next year, they got to basically repay those past due amounts before they can re-sign. This would have stopped that, but that's also suspended. For 2026, they would have reinstated a one-year failure to reconcile. So people who didn't file the form with us to reconcile their past APTC amounts, right now, they have to have done that for 2 years before they lose eligibility. This is going to go back to 1 year. So if they didn't file, so in 2026, if they didn't file their 2025 return reconciling APTC, they're not going to be able to claim, not be able to qualify for Affordable Care Act insurance until they've filed that. Charging some people a fee for passive re-enrollment. So this is something where if you're automatically re-enrolled, you can't have a zero premium stuff. It's going to require at least a $5 premium. Again, you have to kind of look at these in light of the OBBB changes. OBBB at 2028 is going to, 2028 is going to say you can't automatically re-enroll anyway. So this is going to be a temporary provision. Pre-enrollment verification for the special enrollment periods, again, going towards the documentation that's required to be able to get the Affordable Care Act insurance. So these are all things that are now in place. So these weren't subject to the court stay. So they eliminate the low income special enrollment period. There was a rule that came in during the Biden administration that said people with incomes at or below 150% of FPL could basically change their ACA policy anytime during the year. That's gone now. So DACA recipients are now ineligible for marketplace coverage. Allows less time to resolve data matching issues. So if you have problems resolving the information you provide, you only get 60 days instead of 90 days. It shortens the open enrollment period for 2017. So the open enrollment will only run from November 1 through December 15th. So obviously these are all pretty dramatic changes that are going to impact many of our clients. What we're going to see, especially the subsidy thing, but I think in general, this is all going towards fewer clients being covered by ACA, but those that are need to be really careful about accurately reporting income. You should be prepared at a minimum to give your clients who you believe will be impacted, kind of a heads up about these changes. But again, the one I emphasize the most is the elimination of the repayment limits. And I think that's it. Yeah. So this is the end of the OBBB discussion. So this is that handout. For those of you who didn't get that, you will get this. But again, this is my attempt to kind of show you effective dates for all these different provisions that we've talked about so that you can have this at hand. So if you got a taxpayer coming in saying, well, I thought I could do this under the new bill, it's like, well, yeah, you can, but it's not till 26 or it's not till 27 or something. Yes, Kara?
Question is, since the OABB changes happen after AGI on 1040, do they not apply to the ACI's modified adjusted gross income calculation of family income and used to determine with family size the amount of APTC?
Sorry, you're going to have to repeat that one.
So,
And even then, I'm not positive I'm going to understand
since the changes happen after the adjusted gross income on a 1040, do they not apply to the ACA's modified adjusted gross income calculation?
Okay, so all the OBBB the deductions that we talked about are all after AGI, as we talked about, they're between AGI and taxable income. So the modified AGI that drives like the repayment limits and all that kind of stuff won't be impacted by those deductions. I think that's responsive to the question. Any other comments, questions? Okay, we're going to take a break. We're tired of OBBB. Let's take a 15-minute break, and we're going to come back and cover what's left to talk about for this year. Five changes we need to know about. So the energy efficient home improvement credit, which is the only one that's in place for us, was passed in 22. The statute required that beginning in 25, the manufacturer had to register with the IRS and obtain a qualified manufacturer identification number, QMIN. In addition, the qualified manufacturer had to assign a PIN to all qualifying property. For years after 2024, the statute required that the PIN be included on the tax return to claim the credit. So this was going to make our life really easy with the energy credit because it was going to require them to issue a PIN for qualifying equipment that they had to put on the tax return. So the days of us trying to figure out, oh, is a 15-SEER HVAC system good enough? That was all going to be gone. Well, guess what? That's not true. So first of all, OBB terminates this credit at the end of 25 anyway. But for this year, the IRS, and this was before OBBB, issued guidance on these requirements for 25 and beyond, although the post-25 is obviously irrelevant now. Beginning in 26, the IRS was going to require that PIN on the return to be able to claim the credit. But for 25, they decided as a kind of a phase-in of the new requirements that for 25, all they were going to require was the QMIN. So all you needed was this 4-digit qualified manufacturer identification number was the only thing that was going to be required. So you didn't have to have the PIN for 25. So the 5695 has been revised, and I'll show you in a minute that to require the cumin, also tax layer's been fixed for this, on the form for all qualifying property other than insulation and home energy audits. So for those two, you don't need a qualified manufacturer identification number, but for everything else that qualifies for the energy credit, you have to have a cumin. So it'll be required in 5695 for all heat pumps, windows, doors, water heaters, and all other energy efficient items other than, again, insulation and home energy audits. It's a 4-character code, a letter, a number, a letter, a number. The form has space for the 17-digit PIN. So they set up the form assuming that we were moving into the PIN days, even though it wasn't going to be required for 25, and now it's going to become irrelevant. Without the cumin, no credit can be claimed. So we've got to put that on the tax return this year. Our clients will obviously have to provide that to us. I don't think people are just going to like post their cumin on their website, but who knows? I mean, they might. But we have to have that cumin that has to go on the tax return to be able to claim the energy credit this year. The bill did not change the qualified manufacturer registration process for 25, and the IRS has acknowledged that these rules are still in effect for 25. So we've got to have the cumin. So this is the form itself. This is the 5695. So you see now it's got these blocks for every one of these things. It's got a block for enter the qualified manufacturer identification number and cost of the 2 most expensive natural gas, propane, or oil water heaters, blah, blah, blah. So the cumin is the first 4. The PIN was going to be all the rest of these. You'll see they're blanked out for this year, grayed out, whatever. But you got to enter those first 4 on the return for the credit to be valid. Here's what tax layer looks like, just one example. So most expensive door, you put in the cost of the door, and then it asks for the qualified manufacturer ID number. So what does this mean for us? Unfortunately, it doesn't make our jobs any easier. In fact, makes it more difficult because now we've got to have the cumin in addition to everything else. Implementation of the PIN requirement would have eliminated the need for us to assess whether the improvement qualifies, but they delayed that to 26. So we're left with requiring a cumin. All that tells you is that the manufacturer registered with the IRS. Doesn't tell you anything about whether the heat pump your taxpayer bought qualifies for the credit or not. It just says, yeah, carrier registered with the IRS, and here's carrier's 4-digit cumin. It doesn't say, is my 15.5 SEER heat pump any good or not? So that's kind of where we are with the requirement stuff for the cumin. So again, you're going to have to ask your taxpayer. So that's one I need to remember, make sure the intake sheet addendum that we do, I need to make sure I put that in there too. Okay, so in addition to the cumin requirement, they also constantly change what's required to qualify for the energy credit. There was a significant change for heat pumps. It now bumps up to what's called the most efficient category. So for 2025, the CR2 rating has to be 16 now. It was 15.2, and then all these other things. So 16 is a pretty significant jump. In the past, it was all except pretty much the cheapest stuff would qualify. This is going to be a much higher threshold for heat pumps to qualify. Central AC split systems, again, big jump from 16 to 17 on those. Windows, the factors changed. I'm not going to read this to you. I'm just telling you the significant changes for this year. One of the important things is knowing what zone you're in, and I'll show you a little map in a second. But you can check your zone for windows, doors, and skylights by going to this website. So you just put in what county you're in, and it'll tell you what zone you're in and what the requirements are for windows, doors, and skylights for your county. So this is what the map looks like. So most of the state is what's called South Central for windows, doors, and skylights, but the far western part of the state is North Central. So again, if you can figure out where you are in the state, looking at that little map, that's great. Otherwise, you'll want to go to this site to figure out if you're not sure whether your county's in the North Central or South Central because the criteria change. Okay, so that's the end of energy credit. Any questions, comments on energy credits before moving on? Yes, sir. Hold on. Get you a mic. Got one here. But the best part of energy credits is I don't have to talk about it next year. So.
Hi, so on this subject, so the IRS does have a list of manufacturers that have obtained this and the date they obtained it. They don't have the number listed on the site with it, which would be really handy. So you do have to look them up individually, but there is a list of manufacturers that you can check to see if it does qualify.
To see if they have a cumin.
Yeah, to see if it's a cumin. And then
Okay, so it'll
you'd
tell
have
you
to
that
look up the
yes, carrier
qualification of
registered,
the
but it
system.
won't tell you what the cumin
Right,
is.
so it's not going to tell you that it's a 15.4 SEER2 system that to qualify, but it will give you the initial information.
Okay.
And then you have to dig past that to actually see whether or not the item qualifies.
Yeah, yeah.
And often installers will tell people that
Yeah.
it does qualify and it does not.
Exactly. Every taxpayer thinks theirs qualifies. That's the starting point. So. Okay, thank you for that. Okay, paper checks. A lot of you have probably heard about this. The IRS announced that as of September 30th, 2025, it will no longer issue paper checks for refunds. So supposedly that is already in place. Taxpayers are encouraged to use direct deposit. This is the IRS's language, not mine. If a taxpayer does not have a bank account, the IRS recommends opening one and provides some resources for taxpayers to do that. So again, they're trying to push people to have a bank account. They also said that some mobile apps and prepaid debit cards can be used as long as the provider has a routing number and account number that can be used by the holder for direct deposit transactions. So you just want to make sure they give you a routing and account number that you're absolutely sure that for direct deposit or ACH transactions that this will work for that purpose. And the other thing they said is that taxpayers can still pay amounts due by check, but that's also going to be phased out, but they haven't told us when. So that's coming down the pike is you're not going to be able to pay by check either. The IRS says they promised to give us more guidance before the start of the filing season. So we'll see. But so we should get more information on this. One other thing that one of the folks here handed me was something that Drake software has added, which was really interesting. I don't know if this is a Drake software thing or a requirement, but it says our tax return preparer has informed us that receiving a refund via direct deposit is more secure than receiving a paper check. This looks like kind of an official form. We understand the IRS has made changes to their refund processing in accordance with this executive order. We will receive IRS Notice CP53E requesting that we log in and create an account with the IRS and provide bank account information or an explanation for why it can't be provided. If we fail to provide bank account information, the refund will be delayed for 6 weeks. I don't know what that means, but delayed for 6 weeks. But so are they going to issue me a check? Or I don't know. So again, I'm not sure if that's exclusive to Drake or if that's going to be a general thing, but so more to come on this one, but again, not a real positive development for most of our clients or a lot of our clients. Any questions, comments on that? Oh, yep. Mike?
I know it says that you are not allowed to do check, and a lot of our clientele is of the elderly who are not comfortable with any other method.
Yep.
How can you give guidance on persuasion methods to get them to?
You have two choices. You can either get your refund and do whatever the IRS tells us we have to do, or you can not get your refund. It looks like that's the direction we're going in.
Yeah.
But again, without more guidance from the IRS, I can't really answer that yet. So that's another one that if the IRS comes out with more guidance, I will pass that along to folks. So
And with our site, is typically a practice that if they owe the IRS, that we give them a pre-addressed envelope for them to be able to make the payment. Is that something that we just shouldn't do anymore?
Well, again, they're saying that paper checks are going to be phased out for paying, but that has not yet happened. One more. So until they tell us we can't send paper checks, I would say, now you can keep doing paper checks. But I know we have a lot of people who do like estimated tax payments. And so we're going to have to kind of warn them that sometime during the year, the IRS may say you can't send them a check anymore. You got to go on and either set up an account on irs.gov, which is what they would love everybody to do, or you have to go in and pay the estimated tax through their direct payment system.
So this is more of a comment, I think. Obviously, people are supposed to use their own bank accounts. There's nowhere that I recall we enter a name for a bank account on TaxSlayer. Does anybody know for certain that the name on the bank account has to match the taxpayer's name?
Yeah. Tanya, why don't you speak up for a minute? Okay, that's further. Tanya worked in field assistance. She's going to provide some information.
So if they provide an account that their name's not on, they send the money back to the IRS. So then people will come in and say, I didn't get my money. And also, when I'm working at the Vita site, if we do all that and then they don't have a bank account information, then we're not going to be able to complete the transaction that day. So I think that's going to be something that we have to make sure when they make an appointment that they have a valid account information to bring in, because we pretty much complete it and submit it.
You're right, because I mean, you got to tell TaxSlayer, how do I want my refund?
So then they would.
If they don't have an
waste our
account,
time. Yeah.
but again, we're maybe going to get more guidance from the IRS, and then we'll see what TaxSlayer says about that.
Yeah, and I'm going to let Carolyn talk too, because she's another former internal revenue person who has additional information, okay, from National.
All right, I'm on the Taxpayer Advocate website, updated December 4, 2025. And it reads about paper checks.
Okay.
Getting the paper check. Taxpayers who do not provide bank account details or request an exception for 2025 returns will face delays. The IRS, like you said, Bill, they'll send a letter. IRS will send a letter requesting direct deposit information and providing information on how to request an exception. And there is an executive order that grants the Secretary of the Treasury to issue approved authority on exceptions. And then they have a list of exceptions: the unbanked, Americans living abroad, taxpayers with religious constraints like the Amish, victims of domestic violence, and individuals with disabilities. So as Bill is saying, more to come on that, with specific guidance. But according to the Taxpayer Advocate, the National Taxpayer Advocate had issued a recommendation to the IRS that says that not everybody's going to have a checking account, and there should be an exception. So according to their site, according to the website, they should get a letter say, hey, you forgot to put your route number and account number. Please provide it. If you don't have one, there's going to be a form that you can fill out an exception to a bank account. So more, like you said.
Good luck getting that refund. I mean, I think you just stated that you want a paper check. Unless TaxSlayer takes that choice away, if they don't have bank account information, I think your only choice is say issue a paper check, and then you're going to apparently, and that's similar to what this was saying, is IRS is going to send you a notice, and it's going to say, hey, you didn't include direct deposit information. You either need to provide that or provide us with a exception, and then we'll determine whether or not we agree with the exception. And then I guess that means they'll issue a paper check, but I don't know that yet. I mean, there's also been some suggestion that they might issue, prepaid debit card things or something like that, as opposed to issuing a check. But why that's easier and cheaper than issuing a check is beyond me. But
Years ago, Virginia used to issue a prepaid debit card and gave you the option of keeping it and having them automatically reload your
Oh,
next year's
interesting.
refund.
Okay.
So in a way, that's a cost savings to them. They're not issuing a check, so that
Yep.
could be something
It could be.
that you
Yep.
IRS people can talk to.
Yeah.
It's a good suggestion to offer to tax slayer, if anybody's listening.
Yeah. So obviously more to come on that one. You're throwing things at me now. Huh? Okay. Okay. Math error notices. Congress passed a law this year to require the IRS to issue math error notices that are written in plain English. Isn't that a surprise? And provide more detail to the taxpayer about the error. Notice has to include a description of the error, the line item on the return, an itemized computation of the math error, and any adjustments this causes to such item as AGI, credits, etc., and information about requesting an abatement. Oops, that's it for that. So that'll be interesting to see what their interpretation of plain English is versus ours. But at least that's moving in the right direction, because some of you I'm sure have seen some of these notices, and it's like you have no idea what the problem is or how to fix it or anything else. So I think that is a positive development. Okay, rolling along here, inflation adjustments. So these are the significant ones. There are other little ones, but I just always like to point out the big ones. The additional standard deduction for taxpayers. Not that you need to know all these because they're all built into TaxSlayer, but it's more of like, there's some things where it's like, it's helpful just to know that that's changed. The additional standard deduction for taxpayers 65 or older or blind increases from $1,950 to $2,000 for a single or head of household, and up to $1,600 for married filing separate and qualified filing spouse. The income limit for the qualifying relative test increases from $5,050 to $5,200. So you'll see that reflected on the intake sheet already. The kiddie tax unearned income threshold increases from $2,600 to $2,700, so they can have up to $2,700 of unearned income, including scholarship income, without triggering the kiddie tax, which if the kiddie tax gets triggered, it's out of scope. The HSA contribution limit increases to $8,550 for family plans and $4,300 for self-only plans, plus the extra $1,000 if you're 55 or older. The cents per mile deduction went up from 67 to 70 cents. Charitable miles remain at 14 cents per mile, and medical and moving miles stay at 21 cents per mile. These are the repayment limits for our last year of repayment limits, just so that you've got those. But you can see, I mean, the people below 200%, it's only $375 if they're filing single. That's going to go away in the future. So form changes. Not all of this is going to be in the notes because I didn't think it made sense. I just kind of want to show you some things. You probably have already started looking at the forms, but just to point out a few things that have changed. So this whole section up here is new. One of the things that the IRS did with the forms this year is there are a lot of things that we did last year where it would type in something and then have a number. So it, like if the spouse was deceased or the taxpayer was deceased, it would say deceased and the date. Now that's going to show right up on the return. We're going to see the same thing for like rollovers and qualified charitable distributions, same kind of stuff. So they're trying to get rid of that, having to type stuff in. Instead, it'll appear on the face of the form. Here's a new question for us. Check here if your main home and your spouse's if filing a joint return was in the U.S. for more than half of 2025. So now that will get answered by when you fill out the personal information section of TaxSlayer, it will answer that question. You're going to see this as well as a lot of the dependent stuff. They're trying to make it really obvious on the face of the return whether or not you qualify for the earned income credit and potentially some other things like child tax credit as well. So the reason they're asking that question is if you're wanting to claim the EIC and you don't have a qualifying child, you've got to have your main home in the US for more than half of 2025, sorry. And so that's why it's checking that box. The dependent section has changed pretty dramatically. So you've got this check if lived with you more than half of 2025, yes, and in the US is a separate yes box. So that's relevant for claiming the EIC for a qualifying child. Both of those have to be true for EIC. And the first box is also relevant for a lot of other tax benefits, including child tax credit, head of household, qualified surviving spouse, and ODC. Again, all we do is the same thing we've always done, just put the information in the personal information or dependent pages. TaxSlayer will check these boxes if appropriate for us. I'm sorry? The date of birth. It doesn't show up on the tax return.
Okay.
It's in the EIC form, isn't it? Schedule EIC has the date of birth, but it's not on the front of the 1040. Check if they're a full-time student or permanently and totally disabled. Those are new. Obviously, those are relevant for the qualifying child test because that changes the age test. Then there's this new box here. Check if your filing status is MFS or HOH and you lived apart from your spouse for the last 6 months of 2025, or you're legally separated according to your state law under a written separation agreement or a decree of separate maintenance, and you do not live in the same household as your spouse at the end of 2025. This is the exception we talked about a little while ago for married taxpayer not filing a married filing joint return who wants to claim the EIC. You've got to qualify for that exception. In the past, there was nothing on the return that showed that you qualified. You just basically self-assess that. Now there will be a little checkbox saying, yes, I qualify, and therefore it'll put the EIC on the return. Some other changes once we get down into it. Check if your child's dividends are included in this or include your child's capital gains. That's for people where they're paying tax on the unearned income of their children. That's Form 8814. That's out of scope for us, so we don't really care about those. These are interesting. So for IRA and pension now, we have boxes for rollovers and QCDs. So now it will show right on the form, is this a rollover, is this a QCD, and the amount will show there. So if only part of it was rolled, then you'd be able to see that on the face of the return. What was, again, started out sounding great and then got disappointing was they, on the 1099-R, there's a new code Y in box 12 for qualified charitable distributions. Great, this is something we've been asking for years. But then the IRS came out subsequently and said, well, that's optional for 2025. So for 2026, this will be great. So QCDs, we'll know that right away because the 1099-R box 12 will have a code Y and we'll know it's a QCD. You might see that for 2025, but again, once again, it's not required. So whether or not they check that box or not, we don't know at this point. Good question.
Yes, sir. It's about RMDs. So when because we have a lot of, I think I said yesterday, we have a lot of retirees where we're at. And so sometimes when you get that 1099, you can't, they're telling us, well, this is part of an RMD, but I used it as a, qualified charitable distribution. And sometimes the codes are not right.
Correct.
So we're lots of times using what they tell us, not necessarily what's on the form.
Yes.
So will there be another new code or this code or any other code that's going to help with determining which of because sometimes they have 10, because they've got small things, they've got big things, they've got,
For next year, this should fix the QCD problem. So this should alert us. They're going to put the burden on the payor to tell you, was any part of this a QCD? If it was, they have to now put that on the box in box 12 to say, yeah, $4,000 of this was a QCD or $2,000 of this was a rollover. They're going to have to do that. For this year, we have nothing to do but take the taxpayer's word for it.
But in addition to that, will there be something ever that tells us it's their RMD or what portion of it is their RMD?
I don't think so. I'd be surprised. Because that calculation, the IRS can't make that calculation, and neither can the broker, for example, because if you have multiple accounts, then that calculation is based on the total of the account. So if they're with different brokerage firms, they would never know that number. So I don't think we'll ever see that one. Remember, there's also the public safety officer exclusion of up to $3,000 in health insurance. That one, apparently, there's still not going to be, there is this PSO box, but there's not going to be anything on the tax return. On the W-2, the 1099 that says PSO. So they fixed QCDs, they didn't fix the PSO thing. TaxSlayer changed the way QCDs are entered last year. This is just a reminder about how to enter QCDs correctly. I'm not going to go through that, just that tells you how to do it. Okay, so here's a different layout for this section. So it separates the itemized and dual status questions out. So again, just a little bit more detail on the return. You remember a few years ago, we tried to get to like a postcard tax return. We're kind of moving way in the opposite direction now. So here's where our additional deductions from Schedule 1A. So all the new OBB deductions come in there. OBB. Now, if you made estimated tax payments with your former spouse, you have to enter their SSN. Don't see that one a whole lot, but if you do, that's to allocate it. Make sure it's being, the IRS is just checking to make sure that it didn't get claimed twice, basically, on 2 MFS returns or whatever. There are new lines for clergy. That's quickly out of scope for us. And if you don't want to claim things, new lines for that. Schedule 1, there's a new checkbox for an MFS filer making a traditional IRA contribution. If the taxpayer spouse is covered by a retirement plan, the taxpayer had modified AGI of more than 10,000, and the spouses live together at any time during the year, you can't take a deduction for contributions to the IRA, and then it will now check a box on the return saying that. This is the new Schedule 1A. This is the whole thing. I've showed you pieces of that, but that's what it looks like for all our new deductions. Schedule D has some new codes. So we used to just have A, B, C, D, E, F. Now we've got G, H, I, J, K, L. And those are all for digital assets. So all the new codes are digital assets. So if you see one of those, it's out of scope. Can't touch that return. So if you see anything with a G, H, I, J, K, L on it, those are the long-term or JKL. Those are all out of scope. So we can't touch that tax return. I thought this was kind of an interesting change on the intake sheet, where last year, the question about can anyone else claim the taxpayer spouse on a tax return, that was to be completed by a certified volunteer. Now we're putting that back to the taxpayer, which I think is really fascinating because they have no idea whether that's true or not most of the time. But anyway, that's a change on the intake sheet. For OBBB, this is the only substantive change was they stuck in this purchased a new vehicle and the VIN number. So that's on the intake sheet now, but that's really the only thing that I've noticed that changes on the intake sheet because of one big beautiful bill. What about TaxSlayer changes? Not much here either. TaxSlayer actually, give them credit, they've done a really good job of updating everything this year. It's actually in much better shape, including all these new OBB deductions and stuff. They seem to be in pretty good shape this year. They have these new questions about if you check married filing separate, it now asks these additional questions. Did the spouse live with the primary at any time during the year? If so, that jacks up how much of the Social Security is taxable. And then the spouse itemized on their separate return, that forces your taxpayer to itemize. It now has a new box for non-resident alien, generally in scope only for taxpayers with MF, FJM, or Q visas. And you have to be certified for foreign student returns. Otherwise, you shouldn't be checking that box. North Carolina changes. Okay, this is going to be a short discussion. North Carolina tax rate falls to 4.25% from 4.5%, so slight reduction in the tax rates for this year. After 2025, the rate will fall to at least 3.99% next year, but could fall even further based on current law if certain collection thresholds are met. As you may know, we don't have a new budget yet. The budget started July 1, and we don't have a budget yet in the North Carolina legislature. The Senate budget wants to accelerate the tax reductions to get down to 1.99% as the income tax rate as early as 2031. The House is being a bit more conservative and saying, yeah, we're going to go to 3.99, but these thresholds for further rate reductions, it wants to increase those because the House is concerned about revenue collection. The Senate apparently is not quite as concerned about that. So that's the primary thing that's holding up the budget discussions, that they can't agree on those thresholds. Okay, let's talk about North Carolina conformity. So this going to kind of bleed into all the OBB discussion we had. So North Carolina's tax computation begins with federal adjusted gross income. I will say that not all states are like this. So for South Carolina, for example, it starts with federal taxable income. So they have a much different issue with respect to all these OBB deductions than we do. So for us, because it starts at federal AGI, that's before all the OBB deductions. And so for North Carolina, they're not going to apply. There's no correction on the North Carolina return for the OBB deductions. If North Carolina wants to do that, they're going to have to pass a bill to say that. So North Carolina legislature is going to have to act if we want to say no tax on tips, no tax on overtime, all that stuff. And that would then get added to the Schedule S. They've said they're not even going to meet till next year. So who knows when we'll know whether that's going to be true. And my hope is they don't try to retroactively apply it to 25. But I can't promise you that. A bill was actually introduced in March in the North Carolina House that would allow a deduction for bonuses. They went their own direction. Bonuses up to $2,500, overtime and tips, but it hasn't passed the House or the Senate. So basically, North Carolina, nothing's changed with respect to all these new deductions. Won't apply to North Carolina at this point. It's going to take action by the legislature to make that happen. Scope changes. One of the things that, this is my comment to my relationship manager, that drives me nuts. You're my relationship manager, so yeah, you drive me nuts. And no, one of the things that I get really frustrated with is the fact that they don't highlight what's changed in the scope every year. And you know, the scope list is like 20 pages long. And we have to go through there and figure out, oh, they changed this word, or they put in a not when it didn't used to have a not, or whatever. I mean, it's like, to me, it ought to be incumbent on the IRS to say, here's a highlight of all the changes that occurred in scope between last year and this year. That's my suggestion, sure, would help us. But instead, I went through all of it trying to kind of find the things I could find. I don't guarantee you I caught them all, but these are the ones I saw. 1040 Schedule C, the total expense limits increased from 35 to 50,000. I think this is kind of crazy because that to me is we're starting to kind of cross the line of, is this a small, simple little business? Getting up to $50,000 of expenses, but that's not my decision. Big Uber drivers would have that problem for sure, but yeah. Form 1040 Schedule D and Form 8949 exchange traded funds, ETFs, have now been added to the list of in-scope capital transactions. So now the list for in-scope is stocks, mutual funds, ETFs, personal residence, as well as bonds reported on a brokerage statement with capital gain or loss only. I personally would tell you, I always read it as including ETFs. So to me, this is, yeah, it's nice to see it, but I wouldn't have said that was out of scope in the past. INT form, the 2025 list removes from the OOS list. This is just one I thought was really fascinating. Bond premiums on tax-exempt bond that exceeds the tax-exempt interest. So again, not an area that I'm an expert in, but my understanding is that if tax-exempt bond premium paid off, when you see tax-exempt bond premium that was paid, it offsets tax-exempt interest over the remaining life of the bond. Any additional amount reduces basis in that bond so that when you sell it, you potentially have a tax issue. They made that in scope for us. I find that really shocking because there are multiple other examples of ones where there's a basis adjustment involved. It says it's out of scope. We can't touch that. So I don't understand this one at all. Form 1099-R and CSA 1099-R. The list deletes box 7, code 8 from the OOS list. So this is all dealing with somebody makes an excess contribution to an IRA and they want to pull it back out so that because otherwise they have to pay a penalty. So they want to pull that excess contribution out before they file their tax return. So Code 8 is used to report the distribution of excess contributions and the earnings thereon to avoid the additional tax on excess contributions. But Code 8 is only used if the excess contributions and related earnings are taxable in the current year. If the contributions were made in a prior year, the distributions reported under Code P, which is still out of scope. So let me give you an example so this makes a little more sense to you. So if a taxpayer made excess contributions during 2025 and distributes out the excess contributions and related earnings during 2025, so they catch it during 2025 and they take out the excess before you ever get to the end of the calendar year, the 1099-R Box 7 should show Code 8. The return is now in scope. It used to be out of scope. And the taxpayer's taxed on the 2025 tax return on the amount of earnings that were distributed with the excess contributions. So when you pull that out, you're required to pull out a proportionate part of the earnings for the year, and those proportionate part of the earnings are taxed in 2025. So if you do that all during the same calendar year, it's now in scope. That makes sense. I mean, it'll all be reported on the 1099-R, should be good for us. What I think is kind of interesting is you also can make the distribution in 2026 as long as it's done before the due date of the return. If you do that, the way the tax code works is all those earnings from when you put the contribution in until you take it out, which could be in 2026, all that gets taxed in 25. So you have to file an amended return for 25 to take all those earnings that were distributed and put them back in 25. But what's interesting is that Code P, which is this would be a Code P, that's out of scope for us, which is kind of bizarre in my view because the 2026 return doesn't reflect anything for the contribution. You'd have to file an amended 25 to report all of this. So why the 26 return should be out of scope to me is a bit bizarre, but that's what they did. I've already talked about this. We have the new adjustment codes for digital assets. Those are all out of scope for us, so we can't touch any of those. That's it for, oops. Oh, it finally worked when I didn't need it to. That's it for changes for 2025. Any comments or questions before I do a quick little review of AOC workbook and let you get out of here?
Okay, this is one about South Carolina. Can you speak on?
I don't know much about South Carolina tax law.
That's not.
So I'm not sure I can answer that one.
Oh, okay. We're not doing South Carolina.
Nope. Okay. AOC workbook. I don't know how many of you ever used this thing or not, but this is designed to help you with the American Opportunity Credit when you have a situation where there's scholarship money involved and you're trying to figure out how to, because we have the opportunity here, this is a great opportunity we have as preparers to get people bigger refunds. And the way we do that, basically, is by including more scholarship income on the student's return in order to create more qualified educational expenses to generate the AOC credit. And what the workbook is designed to do is to help you do that. So if you haven't ever used this, I encourage you to try it. There is also a calculator on, I don't know if any of you ever used the CoTaxAid tools. So cotaxaid.org/tools are what are called the Bogart tax calculators, which I understand Mr. Bogart recently passed away. Unfortunately, so hopefully somebody will keep those up to date, but that was sad to hear that. There are some amazing calculators. One of them is an education calculator. It is a really good tool. It is, my own view, is not the most user-friendly tool in the world. It requires some real knowledge of how all this stuff works to be able to use that tool. So that's always an alternative to this. So if you've used the Bogart calculator before, keep using it. It's great. Use it. I think this is a little simpler. It's a little more restrictive in terms of the things that I can cover in the AOC workbook versus what the Bogart calculator will do. but it's still good for the vast, vast majority of our clients. So I've revised the workbook for 2025. There are always a bunch of changes that have to be made for things like the kiddie tax threshold changing and all, but I've made a lot of things to try to make it more user-friendly. Kenny Hayes, who is the person who maintains taxvolunteers.com, is a volunteer in the Salisbury area, correct? This guy's amazing. He does, I don't know how he has time to do anything other than update the taxvolunteers.com. But he also has given me lots of feedback on the AOC workbook in terms of things to help with usability and everything. So some of these were his ideas, some were mine. But this is what the beginning of the workbook looks like. So this, we will send this out. It'll also be posted on the website so that you can pull it down and use it at your site. So the first thing I want to point out up here is the top is don't use this. This is kind of my warning for, okay, you're too complicated to use this. This is a workbook for kind of simple situations. If you hit any of those, don't use this thing. Bogart actually can't do all these either. So if it gets really complex, you can't even use Bogart. But more than one student, this won't do it. Bogart will. Complexities like Social Security income, we don't see a lot of students with Social Security income. Other credits like premium tax credit and CDCC, so the Child Independent Care Credit. Those are too complex for mine. Bogart can handle most of that. The EIC and the Child Tax Credit are included in the workbook, so that's okay. It's only getting into more complex stuff on the student's return that this is a problem. Students claiming the non-refundable AOC and filing other than single, that would be a pretty rare case, but if that's your case, this won't handle that. And AGI above the income limits. So the AOC starts phasing out once you get above 90,000 and 180. Bogart also doesn't deal with that, at least it used to not. I don't think it does. So when you come to this thing, assuming you've met all those, you're comfortable that we can use this, the yellow boxes are what's telling you, I need something here. So you're going to see it kind of leads you down the path. So you'll put in the taxpayer's name, you'll enter the qualified tuition and related expenses, expenses for books, supplies, and equipment that aren't included on the 1098T. So that'd be, they went to the bookstore and bought $300 of books. That's not going to be on the 1098T. So you'd add that there. That'll compute your total qualified educational expenses. You'll enter the scholarships, enter any other scholarships, grants not included in box 5. That'd be a pretty unusual situation, but just in case you had any, you would put those in. And that'll compute your total scholarship. So you'll see here, this is an example of the yellow boxes are the only things that you can touch and where it's asking for you to provide input. All the white boxes are things that are being calculated by the workbook. Then we get down here, is a student claiming the AOC on his or her return, which should only be the case if the student's not eligible to be claimed as a dependent on another taxpayer's tax return. This is, again, a great reminder of be really careful letting students claim the AOC. In general, that's not the right answer. Not only is it not the best answer from an AOC perspective, it's usually the wrong answer about should they be claiming themselves. Because the only way a student can claim the AOC is to claim themselves. Say, I'm not a dependent of my parents or whoever. Now, sometimes that can be the case. So fully admit you can have students who can claim themselves. They're not being supported by their parents. They don't satisfy the qualifying relative test or whatever. They can claim the credit themselves. So here you would use the drop-down box. So any place where you see this red pops up says use drop-down box. When you click on that thing, it'll give you a yes, no thing. So you'll say, yes, the student's going to claim it, or no, the student's not going to claim it. Yes, sir. I don't know where all the mics went.
Does this worksheet take into account 529 plans?
No. Okay, so 529, one of my prior years, I talked about that. 529, you always have to do that first. Because the reason is, which is not always the best answer, but to stay in scope, we can't have a 529 plan that's partially taxable. And what the optimization does is it would drive you to say you don't want to allocate it to 529, you want to allocate it elsewhere. That makes the return out of scope for us. So if you have 529 distributions, you take those off before you ever get to scholarships.
Could you separate it between the basis versus the earnings?
No, you can't. So if they're 529, those qualified educational expenses, you got to reduce those by the amount of any 529 distributions. So again, here, kind of warning on scope. Again, the yellow boxes are what you're filling in. So here I'm going to start filling in, and you're going to see that it starts changing. So I put in the qualified tuition, I put in the scholarship, it's computed both of those. The question about who's claiming the credit, we moved that up. It used to be farther down on the list because that drives a whole bunch of stuff. So we kind of moved it up just to get people to think about that question early on. The workbook tells you use the drop-down menu to answer the question. You're going to see that quite often. So here, student claiming, I answered the question no. So you see now line 8, see this will, I didn't show it there. Box 8 now says follow the instructions on this line, and it'll tell you at the end, continue to line 9. Then line 9 says if the student has any restricted scholarships, which by their terms have to be used, must be used for qualified educational expenses, but can't be used for items like room and board, you have to put those in because those are treated differently than unrestricted. If you don't have any, it doesn't matter. It tells you, okay, now continue on to line 10. So once you answer question 7, it'll start telling you where to go next. It'll drive you down the page if you follow the instructions. Until question 10 about the student's age is answered, all these are going to be blank because we want that answer first because that's then, again, going to drive things. So that yellow box will appear after you've answered the prior questions. It'll ask for the student's age. Once you answer that, then things happen. So if the student's age is 25 or more than 23, it's going to say, I don't care about all these questions, which are related to whether it's a refundable credit and whether the kiddie tax applies. They're past that age, so I don't care. So it jumps down here and it tells you, done. Final answers, line 27 to 30. So once I tell kids 25 years old, it says, fine, I've already calculated this for you. If you jump down to the bottom then, well, we'll come back to that in a second. If I instead said the kid's 22, now we see all these questions pop up because now I'm potentially subject to kiddie tax. I get into the refundability question. So now I have to start answering these questions. Was the student's earned income less than half of his or her total support? Again, I use the drop-down menu to answer that question. You see this one's blank right now, but we're going to see it reappears in a second. Was at least one of the students alive, parent students alive? Are they filing a joint return? So if I say, yeah, they're 22 years old, the student's earned income is less than half, which is typically the case. Now this question 12 pops up. Was the student a full-time student for at least 5 months? Was at least one of the student's parents alive? Is the student filing joint return? So you answer all those things, and then this box over here pops up to tell you where you go from here. So again, it's walking you through the process saying, once you've done this, now here's some more questions to answer, or else now you need to go to these lines to answer. So one of the things, this line 16 and 17, this will tell you, this will be where you enter what the student's total earned income is, which ignores scholarship income, and the student's unearned income. So that would be like their interest, dividends, capital gains, that kind of stuff would go in there. But their wage income or Schedule C income would be up here. Once I've entered that, again, depending on how you've answered these questions, it may say, first of all, it's going to tell you in line 17, you got to enter 0 here. If you don't enter it, it won't, basically the program won't work. So as soon as you put a number in 16, it's going to say answer line 17. So if I put a 0 in on 17, now it tells me Great, I'm done. Final answers are on 27 to 33. You see, sometimes it doesn't answer that, but here, if it's done, I jump down to the bottom and it tells me, is the student's return in scope? Yep, it's in scope. How much is the tuition paid? That's the only thing you have to enter in credit for TaxSlayer. So you don't enter the scholarship or any of that stuff. Just put that in as tuition paid. And then on the student's return, you have to put $4,000 of scholarship in. So what that's just done is it's optimized the return. It's put $4,000 of income on the student's return. It's triggered a $4,000 qualified educational expense for the credit, which is going to give the parents potentially a $2,500 tax credit. The $4,000 of income on the student's return is typically not taxed. So it's a total win-win because the student doesn't pay tax on that $4,000 you put on their return, but the parents get a $2,500 credit. All this is perfectly permissible. It's all spelled out in the IRS instructions and publications and stuff. So trust me that this is all legitimate. If the student's claiming the AOC, which again, is pretty rare, under the age of 24, you're going to typically have to complete the student's return in TaxSlayer first. So this is the time it gets complicated. So if the student's claiming the credit, which again should be definite minority of times, then they're under the age of 24, you're usually going to have to complete the student's return before you can answer the rest of the questions here. But again, it's telling you that. So it's saying, go to lines, whoops, sorry, that went nuts. So it's telling you here, lines 16, 17, and 20, 22 only. So you'll see these yellow boxes again are popping up to tell you that's what you got to answer. Student's total earned income, unearned income. Then it says follow instructions below to complete the student's tax return. Then this box here tells you basically, here's how to complete the student's tax return, including if you have to add anything here, it'll tell you that if you have to add scholarship income to the student's return or AOC QEE on the student's return before we get to the rest of this. So again, you just follow the instructions on the student's return. It'll walk you through the process. Then because this one says to do 20 through 22, the first one is after completing the student's return as instructed in the prior paragraph and as adjusted by line 18 or 19, is Form 1040 line 22 equal to 0. That means they don't owe any tax. If that's true, in this situation, it's because it's a non-refundable AOC. They don't owe any tax. There's no reason to claim the credit. You're not going to get anything for it. So that's what this section is for. The next section that we get to where it says go to lines 23 to 26, again, I've got to complete the student's return first. Now I jump down here and it's telling me after completing the student's return, does the student show an EIC? Because that's the complication that this has to work through. So if there's an EIC claimed, it's asking all these additional questions about their filing status, AGI, and the number of kids for their qualifying kids. And again, that will then drive the answers up. So that's it. So I just wanted to briefly show you that. I know it's what I strongly encourage you to do is play with this thing because it's actually really easy to use. That's the whole goal here, is to make this really easy. So anytime you have a student that has a 1098T and it shows scholarship income on there, use this tool because there are actually times you don't need to use the tool. It's way easier. Just go ahead and use the tool because it will tell you, it'll instruct you all along the way. It'll tell you this is what to do. Because there'll be some times where you can't optimize and it'll tell you that. It'll tell you, okay, this is what you got to put on the return. You're not going to get any credit or whatever because of the facts. But the tool will lead you through that process. And again, I mean, a lot of times you're going to create a $2,500 benefit on the parent's return for no cost to the student. So of all the things that we do, this is probably the one thing that we can do, probably more than any other, that is going to generate a huge benefit for our clients. That takes us being proactive and doing something about it. Okay? Any questions on that? Yes, ma'am. Hold on. Hold up.
Be looking for some non-taxable tips later, but.
Are you going to email us that workbook or do we have to access it on one of these pages?
Well, okay, so it will be on the website. I'll also try to remember to email it. It has been updated for Excel, but a lot of people don't use Excel, so I have to create an open office version of it.
Oh.
So if you don't have Excel, the Open Office version will work. You have to download Open Office, which is open, so you can do that for free. And that form will work in Open Office.
So when you
But
say
I haven't
it's on
created
the-
that yet.
When you say
Believe it or
it's
not,
on
I
the-
haven't had time to do that.
No.
So,
So it's on the website, HTTPS,
So this-
investment partners.
So first of all, taxvolunteers.com Vita is a fabulous resource with more stuff than you can possibly imagine. It actually leads you to all of my stuff, North Carolina Vita Training Resources tab on that page, or you can go directly to the Reinvestment Partners website to that address. That's where we've posted all the stuff for prior years. So all the handouts, everything is on that page. We will add the PowerPoint and the handouts for this year to that, as well as the AOC workbook stuff at some point. I can't promise you when that's going to happen, but we will do that hopefully within the next month or so. So this is, again, place to go to get resources. Yes, Mike.
Hang on, we're coming. In the digital link, you've made these all active, so they can click on
So,
them and find out.
This is going back a little
I
bit,
don't understand that.
but not a question, information.
Yep.
So the low income taxpayer clinic folks have also, that's legal work to resolve tax controversies between IRS and taxpayers, have also been meeting this week. They had a conference this week. And this issue of not issuing paper checks came up there a lot.
Okay.
And their best understanding of what's going to happen is that if you don't put bank account information on the return, the refund will be issued with the Direct Express system that the federal government uses to issue veterans benefits and SSI and Social Security, where they send a prepaid debit card to the taxpayer. I think it's still going to be the case that if we don't put bank account information, they're going to get a letter that says, give us your bank account information. They have to apply for an exception. And then if granted, they'll get that prepaid debit card. So it's still going to be weeks and weeks of delay. None of that is official. So that's just what they think is going to happen.
Okay.
There's another conference in DC tomorrow. So I should be able to confirm some of that stuff and let you know.
Okay. That's great. Thank you. So anything else, any updates anybody sees that you think the group should know about, please? As you see on this, I give you my email address. The purpose of that is for me to serve as kind of a clearinghouse for information and stuff. It's also for you to ask questions that are about VITA, not about your personal tax life and that kind of stuff. But if it's a VITA related question during the year, I'll try to answer your question. So please use that. But so if you have anything that you hear about that you think the group ought to know about, send it to me and we'll make sure that it gets out. Any other comments or questions about the day?
Thank you.
You're welcome.